Good morning, students. Today we are going to start paper 7 of final direct tax laws and international taxation. And along with me, my faculty, BoS faculty is there, CA Priya Subramaniam and CA Aparna.
Good morning, students. Good morning. I'm Aparna Chauhan.
Yeah, so students, you know that this particular paper of direct tax law and international taxation, it's a very dynamic paper and you have to be updated with the latest amendments which are coming. But it is not that you have to keep the amendments like day-to-day amendments. Rather, we are giving you a cutoff time, like for the November exam, the cutoff date of amendments and circular is 30th of April, 2022. So along with your edition which you are studying, you have to keep yourself updated with the amendments till 30th of April 2022. And along with that, you have to be updated. You kindly go through the judicial updates which are also uploaded on our BoS knowledge portal. So along with all these things, you make your preparation and you know very well that for this particular attempt, your the assessment year is 2022-2023. So kindly keep that into mind and make your preparations accordingly. And while you are attempting the paper also, students, keep in mind that which are the latest amendments which you have to keep in mind, because in a question, if you are given certain dates which are prior or later than 30th of April, so don't get bogged down, because you have to know the updates till 30th of April. So stick yourself to that and attempt your question in that manner only. Another very important thing, student, is that this being a very interpretative paper, so you need to understand the law very carefully. What are the provisos to that, and what are the judgments given by the Supreme Court, High Court. So you need to know those also. Questions may be posed from that angle also, because at this level we are trying to check your interpretative skills, your analytical skills at a greater length. So be very careful while you are attempting. And the students, while answering the question, kindly keep in mind the various the information which is given in the question. You have to come out with, don't do just the calculations, but you need to do the steps also. Which particular proviso you have applied and what is your answer accordingly, it should come out very clearly in your answer sheet itself, because you know very well the stepwise marking is being done in this paper, not in this paper, but in all the papers. So do take care that you are writing all the steps in the answer sheet. Don't keep them in your rough sheet, because it is going to form part of your answer and you will be marked accordingly. And another thing, students, you also know is that this is a paper where 30 marks MCQ based questions are there and 70% is your direct tax and international taxation. So while you are attempting your MCQ based questions also, be very careful that what is asked in the question, what is the scenario like, and there will be 3-4 MCQs based on that. So just see which is the most close answer. Do it through wherever you are struck up. Use the exclusion method, that this is something which is not possible at all, and this is something which is very near, right? So kindly attempt the question in that manner so that you are able to score much better. And one more thing, student, is there that we have also uploaded our MCQs booklets also, January 2022 edition. So kindly practice from there, keeping in mind the amendments till 30th of April. If after January there are certain amendments which have not been covered in the booklet, keep in mind that the amendments which are there till 30th April, apply your answer, understand it accordingly and answer it accordingly. So now, students, I'll be requesting now my faculty Priya and Aparna to start, and they will cover the section wise and skill wise weightage also, and then they'll be taking you through the various nitty-gritties of this paper, how You have to attempt the questions in a particular head of income, and wherever there is a combination, like in PGBP, you will be having a combination. Different heads of income will also be covered in that. So they'll tell you about the various nuances which are there and how you need to deal it while you are attempting your paper, right? So students, another thing more is there is that whichever queries you are having, they'll be taking care of it. And in case after the session also, if you still feel there are certain queries which have not been answered or which you could not actually think of at this moment of time, so what you can do is you can always post these queries in the BOS mobile app, and students, your queries will be resolved over there. And do not worry, BOS is there for you, and we have come to you to take up your queries. So don't hesitate. And any query you are having, you can always come back to us today, tomorrow, and anytime. And you can come through the BOS mobile app, ask your query section, which is very, very, rather students are really liking it. Rather, what I've seen is that wherever students are getting struck up, especially before the exams also, they are calling us, they are writing to us, and their queries are being resolved by our BOS faculty. So the BOS faculty is there for you because they are the ones who have prepared your material. They are the ones who have prepared your MCQ booklet, your case scenario booklet. They have done everything for you. So make use of what all information, what all initiatives BOS has taken, and take your journey to the exam. Take it very, very confidently, and your journey is going to be very seamless if you study in the manner in which our BOS faculty is going to guide you. Right, students? So now I'll be asking my faculty to take up, and I'll be thanking them and thanking all of you for the patient hearing, and all the best for your exams. Prepare well, enjoy the subject. It's a very interesting subject. Towards the end, I'm saying it's a very interesting subject. What you are reading, what you are seeing, and how to apply, that is something you need to learn, because this is really going to help you and it is really going to improvise on your analytical skills. So thank you, students. Now over to Priya and Aparna. They'll now be taking up the session. Just give us some break, a minute break will be there, and we'll be changing the platform. So kindly bear with us. Thank you very much.
Good morning, students. You would have listened to what our Director of Studies have said, and those are very important points which you have to keep in mind, that the BOS and then BOS knowledge portal, what are all the educational inputs which are available relating to the subjects, the study material, the October 2021 edition of the study material, the case scenario booklet, the RTPs, MTPs, all this are for the purpose of your learning so that you are able to face the examination confidently. And the paper is undoubtedly one of the most interesting papers in the CA course, and at the same time it's dynamic, so it sometimes becomes challenging to keep pace with the changes, but this is what makes the subject very interesting also. So today we will, along with my colleague Aparna Chauhan, we'll take you through the important key elements, key problem areas in this subject, or the key amendments which have recently taken place, which need better understanding. So by and large, we are planning to cover it is basically broadly divided into, your study material is divided into 4 modules, and the whole syllabus is divided into sections. Based on that, we will tell you. So the syllabus of the paper, it's direct tax laws and international taxation. Direct tax laws is for 70 marks and international taxation is for 30 marks. As far as your study material is concerned, the October 2021 edition of the study material, that is relevant. It comprises of 4 modules. Modules 1, 2, and 3 relate to direct taxes, and module 4 relates to international taxation. Now, this entire weightages is summed up in this particular chart. So when I take up this chart, we will let you know what is all included. So as far as this is the general question paper pattern, this also tells you about the section-wise weightages. Towards the end, I will talk about the skill-wise weightages also. So as far as this paper is concerned, you know that 30 marks are for MCQs and case scenarios, and 70 marks are for descriptive questions. You have an extra question for choice also. Basically, the question paper comes like this. You have in the 30 mark segments, you have 2 case scenarios, which are followed by 4 to 5 MCQs. Uske alawa, there are independent MCQs in the part 1, that is the 30 mark segment. Now in part 2, which is the descriptive segment, there is 1 compulsory question for 14 marks on computation of total income of a company or a firm. Remaining questions, out of the remaining 5 questions, those are also for 14 marks each. Students have to attempt any 4. And the optional questions, each question, first 8 marks. Out of 14 marks, 8 marks is for direct tax laws and 6 marks is for international taxation. So this is broadly the structure of the question paper. Now, how do you link it with the section-wise weightage? See, section 1, this first column, what we are telling is the section 1. Section 1 comprises of chapters 1 to 12. What is there in chapters 1 to 12? Chapters 1 to 12 have all the substantive provisions, all your heads of income, your clubbing, set-off, reductions, and then assessment of various entities where everything is grouped there. All these provisions which come in the head of income, residential status including, because residential status ultimately determines the scope of your total income. And heads of income, clubbing, set-off, reductions, everything we provide as per the general provisions, you compute the total income. Then special provisions are also there for companies, special provisions like MAT, and also the alternative regimes like 115 BAA, BAB. All these things are there together. Holistically, how do you combine and compute the total income and tax liability, which is more beneficial? All that is dealt with in this chapter, assessment of various entities. So till that, chapter 1 to 12, it forms the core, very important chapters in the entire paper. That is why a very high weightage of 35 to 45% is assigned to this particular section. And what type of questions you get from that? Okay, basically the compulsory 14 marks question, which is skill-wise, if you say, this is evaluation and synthesis. Evaluation and synthesis is the highest skill level, where you integrate the different provisions of tax laws and apply them in making computations, addressing issues. Integration as well as analysis and application, everything is encompassed in this particular question. So that comes from this particular section, and there's a compulsory 14 marks question, which is very sure. Apart from that, you also have one 8 marks question. In the optional, I told you, for each 14 marks question is divided into a 8 marks question on direct tax laws and a 6 marks question on international taxation. So that 8 marks question on direct tax laws, one question again is from this section in addition to the compulsory section. So this might be on special provisions of REITs, on investment funds, securitization trust, or capital gains slum sale, anything. I'm just giving you some of the examples it can be. It can either be an E&S question, that is, which involves integration of one or more chapters and provision, or an A&A provision. In addition to that, because the weightage is 35 to 45%, you might even get total. I told you there's a total of 2 case scenarios in the 30 mark segment. One case scenario can also be from this section. And in addition, you can have independent MCQs. So anything is possible in this particular section. So it is very necessary that you be thorough with all the provisions in this section. Now coming to section 2. Section 2 is what? It's charitable trusts. Charitable trusts and political parties, electoral trusts, that comes 5 to 10%. And this chapter 13 of the study material. Okay. Now the weightage is 5 to 10%. Accordingly, generally what comes, there's an 8 mark question on charitable trust. It asks you to address different issues in the charitable trust, different issues, independent issues in the charitable trust, or it can be a sort of a computational problem, or it can be on accreted income. It can be an 8 mark question. But in case it doesn't come as an 8 mark question, they ask questions for 4 marks, then you can have an independent MCQ. Or instead, if they choose not to ask in the descriptive segment, you can get it in the form of a case scenario also. So it is possible in any of these 3 segments. Then the section 3 is your tax planning, tax avoidance, tax evasion. Again, it carries a weightage of 5 to 10% only, and it's chapter 14. In this, it's whether these transactions, whether these activities like investments and all constitute tax planning, or whether it constitutes tax evasion, that is totally unlawful, or tax avoidance, which is somewhere in between these 2. So that you may be asked to identify, or you might be asked a question on 115 BAC. BAA, BAB also is tax planning. In effect, that is also a form of tax planning, but generally because there's a compulsory question on company and firm, it gets tested, but there's no limitation. This is just the way it normally appears. It can appear anywhere as that part. And then you can ask on applicability of GAR also. That is also possible. So normally the trend, what happens is a 4 marks question is asked. That's why we put 0.5. The whole question is for 8 marks in section 1. And you might ask, generally they ask for 4 marks, and then you might get one MCQ in this particular segment. That's the way it normally appears. Then section 4. Section 4 is 15 to 20 marks. This is deduction, collection, recovery of tax. This is chapter 15. Kindly note, this is just one chapter in the study material, chapter 15, but it carries a weightage of 15 to 20%. So that shows a single chapter carrying a weightage of 15 to 20%. So how important that chapter is, isn't it, Aparna?
Yeah.
This chapter is very
scoring also. It give you a good chance to score good marks in this chapter. One chapter or carrying so much of weightage definitely will help you in scoring good marks in this.
And it's also very interesting. Only thing they have to remember the thresholds, the different rates.
Yeah, that's the main thing. Practically also you must be doing articleship, you must be aware of all these tedious provisions, which are basically in case of practicing training, you are in training, then you are day to day, you are getting into touch with such kind of transactions which are on which tedious is attracted. So this is very practical, jo ki aapne, you all students must have done in your practical training time also.
What she says is very important. See, ultimately, you're at the final level. What you learn in practical training, you should be able to correlate with what you actually study in academic education. So then only you'll be able to answer the paper effectively. So as you said, TDS and TCS provisions are so often used in practical training that some of the sections you may be familiar with. Some of the sections probably you may not be pertaining to non-resident taxation, especially those things. Maybe not everybody will do it in their practical training. So it's a fine blend of both. So for that, you will definitely get one 8 marks question on TDS, TCS, or advanced tax, on applicability of that. So it's important you remember the threshold limits and the rates, as well as the applicability, which section it falls in, all that. And then you might get a case scenario also in addition to that too. or independent MCQs. Okay, because the weightage is 15 to 20%, it's possible that definitely you'll have a descriptive question. In addition, you might have a case scenario or independent MCQ from this section. Then section 5 is assessment procedures, income tax authorities, assessment procedures, dispute resolution, penalties and prosecution. 6 chapters are covered in this particular section. And this also carries a weightage of 15 to 25%. Definitely one descriptive question will come for 8 marks on assessment procedure. Assessment procedure has also undergone a lot of changes recently. So that you might get a case scenario or independent MCQs. So these are the possibilities. As you can see, compulsory is only from section 1. Optional question may almost 1 question from every section you will get it. By and large, they are 8 marks questions, except in tax planning and in the last section, which we are coming, section 6. It's on miscellaneous provisions and special liabilities in special cases. Here again, it's a weightage of 5 to 10%, and you get a 4 marks question in descriptive questions generally, and remaining you may get an MCQ. So this comprises chapters 22 to 23. So these are basically as far as section-wise weightages of direct tax laws are concerned. Okay, so you can see I've left part 2 blank, the 6 marks, because the 6 marks comes next. That is the international taxation, but that comes as part of every optional question. So in that, chapters 1 to 5 constitute section 1. 1 to 5 are what? Transfer pricing, non-resident taxation, advance ruling, double taxation relief, equalization levy. Very, very important. It constitutes 75 to 85% of 30 marks. 1 to 5. This is again, like we said that section 4, TDS thesis is very important. This is also very important because of the very high weightage. So, and all these 4 out of the 5 optional questions, for every question, that 6 mark part is on international taxation, and out of that 4 questions are from this part 1, out of these first 5 chapters. So you have to be thorough. See, you will benefit if you're thorough with these chapters, and it is very essential. You get 4 questions. In addition to that, you might get a case scenario and independent MCQs also from this segment. Section 2, which carries 15 to 25%, that is chapter 6 to 8, is on BEPS, interpretation of tax treaties and overview of model tax conventions. Generally, only 1 question is asked from this, and maybe 1 or 2 MCQs is possible from this particular segment. So this will give you an idea. See, where to give more focus on. That's why the section-wise weightage, what does it primarily indicate? Which you must have more focus on. Section 1, definitely chapters 1 to 12. Section 4 and section 1 of part 2. These 3 are topmost priority wala chapters, which are the chapters 1 to 12, chapter 15, and chapters 1 to 5 of part 2. Charitable trust, even though it has a weightage of 5 to 10%, definitely you will get 1 question in charitable trust. That is for sure. And it is also very scoring at the same time. So all these you give more emphasis on when you are doing your studies. Then as far as majority of the things are analysis and interpretation, as I said, evaluation and synthesis skills are tested in this compulsory question and 1 more question in section 1. All the other chapters, it's basically analysis and application. Some chapters like liabilities in special cases, this 0.5 in section 6, as well as part 2 of international taxation, that is 6 to 8, these chapters, you get knowledge-based question. So the emphasis is more on application and analysis. Like you have it here now, you just see in detail, knowledge and comprehension and knowledge is only 5 to 10%. The testing, I mean, otherwise, of course, for learning purposes, you have to have a knowledge, only then you'll be able to apply. But as such, your knowledge won't be directly tested because it's the final level. It's the application and analysis 60 to 80% and 15 to 30% evaluation and synthesis, the compulsory question in section 1, as well as 1 additional question in section 1. Part 2 may 75 to 85% the chapters 1 to 5, that is based on application and analysis. The section 6, 7, and 8 are primarily knowledge-based, from which you might get knowledge-based question. That's only 1 question. So largely it's your application and analysis which is tested, wherein you have to apply what you learned in practical training as well as what you learned in academic education. Anything further you'd like to add?
Yeah, one question basically we got to receive from the student, how to prepare for the MCQ segment actually. To say, student, please note the strategy for preparation would not undergo change for MCQs or descriptive. In both the cases, you have to prepare in the same manner. Of course, your manner of presentation in the examination would undergo change. See, in MCQs, of course, you need not to give any working notes, anything. You have to choose an option, right? For that purpose, what you require, you have to read the MCQ properly, read all the options very carefully, then only you choose it, right? This is the one thing, because here if you go wrong, then you will not get any mark, you will get 0 only. But in case of descriptive, you have a chance for step markings. So this is the basic difference while attempting the exam. But for preparation strategy, as far as we say, then they are same. And for practicing MCQ, of course, you practice from our case scenario booklet, right? A case scenario booklet is there, the RTP questions are there, the MTP questions are there. From these, you prepare for practice the MCQs. It will give you an idea how the questions are being asked in the exams, right? So this is the preparation. Keep in mind the preparation strategy is same. For one thing, that DT is really very interesting subject and very scoring as well. But what you have to do, you have to do effective study. Means you have to understand the provision, understand how to apply in the particular circumstances. Here you don't have any option you can change something. There is no developed formula or something like in science or something, right? Ki aapne kuch formula develop kiya, you have developed something. No, their provision is provision. Whatever is written, you have to understand that provision and apply according to situation. So according to the circumstances, according to several things, the amendments keep on taking place to capture the reduce the revenue loss. So for that purpose, the amendments are keep on coming. They will also come to know in later point of time. So all these things you have to keep in mind. कि आपका amendments आए क्यों, provisions क्यों है, that of course you know, but you have to learn these provisions, and you should know how to analyze these provisions. 2 or 3 provisions also has to be integrated together. Those kinds of provisions we are going to cover in our session also. And in this session, our main focus is on the major amendments which are being made by the Finance Act 21, and the important concepts which are usually being tested in the examination. These things we are going to cover in our session. You will come to know in our later session.
One thing is how to improve your analytical skills. Many students have a tendency, because when you see an illustration or question, just look at the answer, just see how it is solved, because that way I can learn it faster. But that does not make your learning effective. Your learning will be effective when you do it on your own. Okay, you make mistakes, you keep on making mistakes in many problems, it's okay. Remember that it's perfectly normal, and it's very good, in fact, that you make mistakes, because that will give you a chance to correct yourself and timely correct yourself, so that you don't make the mistake in the exam. If you're going to read it fast now, of course you'll be able to. Otherwise, I might take 3 months for reading the direct taxes. If I read the answer directly, I'll do it in 1.5 months. But that is not effective learning. That may not help you in the exam circumstances, because suppose you ask not the third this way, but I'm going to ask you something, some small change which I make in the question. You will remember what is the answer given in the study material or in this one, and accordingly answer it. You will not note that change. That you will be able to note only when you solve it yourself. And don't get scared or don't get disheartened because you're making mistakes. Mistakes is the way in which you can learn. By committing errors, you learn and you correct yourself. Your knowledge of the subject becomes better. They say for direct taxes, with every passing year, now you realize that how less you know, because there are so many changes which taking place. You have to keep yourself abreast. So it's okay if you make mistakes. It's perfectly normal, and it's very good, I would say. Rather, it's very good if you're making mistakes now, because you get an opportunity to correct yourself and understand the concept correctly. Every problem you're making a mistake, it's okay. But do it on your own and compare the answers. Find out where you're going wrong. Revisit the concept in the study material. Correct yourself and mark that particular concept, so that particular adjustment where you're going wrong, so that you can revise it the day before the exam. This is the correct way of learning. Please do that first. Here we have Sumit Jain. He is posted in the query that he has benefited from the mock test counseling session for May 22, and he got very good marks in DT and international taxation. So I'm sure you will all benefit. Please follow the tips which we give you, so that will definitely help you in preparation. We keep counseling students, so we know where they tend to go wrong. In a hurry, if you try to go through all the provisions, go through all the things, that will definitely not help, especially at final level. No,
yeah, ma'am. Yeah, ma'am wants to say you should not read the question while preparing. You
read
should
the answer.
Read the answer. You should solve it by taking paper and pen. Then you will able to know what mistakes you are doing. Actually, when the person knows his loopholes, then only he can correct it. First of all, you should know where are you doing the mistakes. Then you can easily correct. You have the option this time. But exam mein jaane ke baad, after appearing in the exam, you don't have any option to correct yourself, right?
So this is the
which is the right time. This is the time for revision actually. Yahan pe you have to revise all the things, right? And don't take any stress also. In the examination, you please don't take any stress ki mere ko nahi aati, I don't know this question and this question. But when you start doing it, make a strategy ki aapko time management, of course we will going to take you through how you can manage your time during the exam also. So don't take any stress, be relaxed and start solving the question. When you start solving, you will gradually come to know ki, yeah, I am able to recall the things easily. So this is the way you can do well also. Like Sumit Jain, I'm very happy to read Sumit Jain comment that yeah, he cleared his group 2. Thank you, Sumit, for your
and congratulations.
Yeah, congrats.
Saurabh Sarkar has asked whether step marking is given. Yeah, for all descriptive questions, step marking is there. And yeah, brief reasoning you have to give it. See, you don't spend too much of time giving detailed reasons. Give brief reasons for your answer. But what is important, without reasoning, even if your treatment is correct, if you've added, generally it's a PGBP question, and then you have to add, make additions, certain deductions and all. If it is without reason, then, it will not fetch you marks. You have to give the reason. As far as remembering sections are concerned, what I feel at final level especially, the section helps you to learn the subject in a better manner. So if you are able to correlate with that particular section, you can't imagine reading chapter 6A deductions without knowing what the section is.
Tedious.
Tedious and all, without the section. So section, you have to blend it with the section. Of course, if it is not all sections, maybe you will be able to remember, but by and large, reading it along with the section is better. And if you write the section in the answer, it gives a good impression. It gives an immediate impression that person. And if you applied it very correct, the correct section, you will be awarded marks. But if you don't remember the section, please don't write the wrong section. You might end up losing marks for that. So that way, I feel it's easier to remember. It is easier to learn along with the sections, and writing the correct section will add value to their answer. Even though specific marks may not have been allocated for the section, it helps to create a good impression in the minds of the examiner. That's now we can carry on with our this one, so that we are able to complete timely.
Yeah, of course, this thing I think we have already covered. The first question is a compulsory question. So it's a 14 marks question. It can be asked on your companies, computing the total income of the companies or the firm or the tax liability of the companies. For in case of companies, you know that there are concession provisions are also there along with the normal provisions, and MAT provisions are also there, right? So you will come to know that we are also teaching you with the help of the section. We are using the section to you and make you understand the provision. So that way also you try to understand. So in that way you can you able to remember the sections. Like in case of concessional resigns, the concessional resigns, what are the provisions? Section 115 BAA and 150 BAB. These are the two sections which talks about the concessional tax resigns for the in case of companies. Our MAT provisions are also there. In case of normal provisions, if you are supposed to compute the tax liability of a company applying the normal provisions, then you have to compare the normal provision computing. You have to compute the tax liability as per the normal provision. Then you have to compare it with the MAT liability, right? Then in case the normal tax liability is less, then company is supposed to pay the MAT. This is the one way. If the company is opting for concession tax resign, then in that case, they need not to pay, that MAT provision would not apply. So how you will compare in that case? If the company has to pay the tax as per the MAT liability, right? Then the MAT liability has to be compared with the concession tax supervisory tax liability. This is the way. In that case, if question is silent regarding that whether the company is opting or not, the question doesn't say anything, suppose. Then what happens? You have to take a call on yourself that you have to compute the tax liability in the manner which is more beneficial to the company. So you have to see, then 115 BAB or BAA comes into picture. I will explain you, I will just give a quick revision of these two sections which we feel very important. They may be tested in this compulsory question or may be tested in the form of MCQs or in other form also. So these are the some important, we feel ki these are the sections which are really very important for you. We are going to give you a quick revision in the coming slides.
Saurabh Sarkar, we will be taking you through many MCQs in the course of our session today. So we will try to help you with that. Probably you will get more acclimatized. It's the same as we had told earlier. The preparation methodology is the same. Only thing in MCQs, when you're working out, now you should read the question carefully. Yes. You should see the tricky points. Once you worked out, now you might get an answer and which might match one of your options there. So you might instantly think that that is the right option. Yeah. Sometimes it might end up being the wrong options. Wrong options are also generally framed in a manner that if a student makes a particular mistake, they arrive at that particular option. So just because you arrive at an answer at in the first go, which matches one of the options, you should not proceed that is the right option. That's why reading the question carefully is very important in case scenarios and MCQs. It's important in descriptive also, but in case scenarios and MCQs, because if you miss out something, you might arrive at an entirely wrong answer, which is also one of the options. So in fact, we'll be solving many MCQs in the course of our scenarios in the course of our session today, and I hope you will benefit out of it.
Which will help you that how to do the MCQs in the exams. Like in case of 115 BA and BAB, we are going to take you in revise, then we will discuss this point then and there. Then different rates also we are going to discuss there. Assumptions. See, this is a direct tax paper. Tax papers are such key which there is a possibility of some information is not given, or there is a possibility of two views. In that case, you have to state the assumption in your paper clearly. Then whatever view you are doing and solving a question, you please state the whatever assumption you are taking. So that is the very important thing. Don't ki aapne apne mind mein just set kar liya ki this is the assumption we are doing. It will not suffice. You have to mention in your answer sheet. Time limit. This is for section 1. We have it's a 14 marks question, and there are the adjustments. If you do this question, first of all, I feel ki choosing the best, but choose the question which you feel you better know and attempt it first, because the first impression gives the last impression. So it gives a better impression on the examiner also, that the student knows it. So choose the question which you feel that you know better and attempt it. And if you feel that the question number 40, this question number 1 compulsory question is such, and you know the adjustment, many of the adjustment, try to solve it first. But don't spend so much of time solving the first question, or don't spend so much of time in solving the MCQs portion. Like for example, we can explain time management, ma'am, here.
Yeah. MCQs, normally you try to complete it within 45 minutes. Max, you have to, it's for 30 marks. You don't have to, although you have to do the workings there, you have to do everything, but try to do it within 45 minutes so that you're left with more time for the descriptive questions. So for descriptive questions, then you will be left with what time? It is 1 hour 35 minutes, which you divide it around in amongst 5 questions. So how much do we get? 135 divided by 5? 135 divided by 5. So around, we will have 26, 27 questions, 26, 27 minutes for each question. So how do we do it? You can spend 2-3 minutes more in one question, 2-3 minutes less in another question. That's okay. But don't extend too much. Like for one question, suppose compulsory question, you feel that you know very well. Generally, students should be able to attempt the compulsory question well, because the adjustments are more or less what you're familiar with it. Maybe there might be 2-3 extra adjustments that is there, but stepwise marking is there. Even if you go wrong in 1 or 2, it's okay. It will fetch very good now. Just keep in mind whether they ask you special provisions or general provisions. That is very important, because in special provisions, when you go in for BA, BAB, many of the deductions which are normally allowed, like additional depreciation, the contribution for scientific research and all these things are not 35 AD deductions. These are not allowed. So if suppose they ask you directly a special question based on special provision, then you have to accordingly work it out, So read the question very properly. So try to finish it off between 25 to 30 minutes and keep some 5 minutes cushion for checking, because when you're doing in a hurry, then it is possible that you might miss out something. All this is possible when your preparation is very good. Only then you can confidently say, if you know everything, then it's just a matter of putting it on paper. It's just a matter of reading it properly and putting it on paper. So that level of confidence you must have, and with proper revision, I'm sure all of you will gain that level of confidence. So try to complete it. Don't spill it over, because some students tend to spend a lot of time. They see that they know everything. They write very much in detail, and they take off 45 minutes. That leaves you with very less time for the remaining questions. Then ultimately what happens, you'll end up leaving a question that you know, which should never happen. If you know a question, it should not be that because of paucity of time, you're leaving it out. So approximately take around 25 minutes time for each question. That is also possible if you're completing MCQ segment in 45 minutes. Only then that is possible. So when you complete that, then, and remember, in question 1, it is just one question. When it comes to question 2 to other things, you have subparts. It may be one question for 8 marks, or it might be subparts there. Then you have an international taxation also. Simultaneously, you will have to apply for everything. Because when I take up a question 2, and I'm solving it, you have to solve all subparts one after the other. It should not be that international taxation you will solve later. It's not possible. Everything you'll have to solve. So you have your confidence level and your application of provisions. You will do one question on direct tax, one question on international taxation. That's the way you opt for all the questions. See to that you complete each thing within a span of 25 minutes. So that's the way you can effectively do each question. So 25 minutes means you have to see accordingly. Now 15 minutes for the DT part, because it carries 8 marks, 10 minutes for the international taxation part. Or if the international taxation part happens to be a little bit more tougher, you take more time for that. Do a lesser time. It depends upon the complexity level of the question involved. I cannot give you one size fits all here, that particular thing. It depends upon in which question, which is more complex. Somewhere there will be a balance. If DT is more complex, then your international taxation will be relatively simpler. That balance will be maintained. But accordingly, you have to decide your time allocation. The 15-minute reading time will help you all that. This thing there, as Aparna told you, choose the question which you know first, best first. Then whichever question you're less confident in, choose it towards the end only, but leave adequate time for all questions. Then and there do the revision. It's not that afterwards you're going to finish the paper, you're going to have time to redo everything, see everything right from the. So as soon as you complete one question, quickly glance through it to see that you've not missed out anything. That much thing that this will help you manage time in an effective manner. Case law based questions also, it is, if suppose they ask you to do it as identify the issue involved, provision, analysis, and conclusion. If you remember the case law, it's well and good, you won't face problems. Even say, suppose you don't remember the case law, this issue identification you can do easily. Provision also you can identify. When you know all the provisions of the act, you will be able to do it. Or based on that itself, you can give it. It will fetch you some marks. Of course, it is not going to fetch you the full marks. In a case law based question, anyway, the best answer might itself fetch you only 3 marks, because it's subjective type of question. It's the only questions which are subjective nature. By and large, in a computational problem, you can score full marks. There's nothing stopping, because each step and each answer, as and when you get, you score full marks. But in subjective questions, the best answer itself might not fetch you full marks. Just keep it in mind. Why I'm telling you this is, don't devote too much of time for any particular question.
Yeah, this is the main thing. Different, then we are going to discuss about the REITs also. There are difference in schemes. The taxability schemes of the REITs, investment funds, and securitization trusts are distinct. So these provisions also we are going to discuss in our session. Then this is very important again, that analyze whether AMT provisions are required to be applied in case of non-corporate assessing. This information, see, question will not be asked clearly stating in your question that you have to compute the AMT also. Like in case of AMT applicability, you have to check whether the AMT is applicable or not. right? In case of individual, if he is claiming deduction under chapter 6A, right, or 35 AD or 10 AA deductions the person is claiming, then this AMT provisions would get attracted if the adjusted total income exceeds 20 lakh rupees in case of individuals and HA. Right, so these things now you have to yourself analyze. Yeah, you have to compare the liability, then you have to compute the normal tax tax liability as per the normal provisions, then as per the AMT also. Then you have to compare that how the assessee is going to pay the tax. So this AMT provision you have to yourself analyze and understand the AMT provisions also. Accordingly, you have to compute the total income and tax liability. Then there is a difference between tax payable and tax liability. If the question clearly states you have to compute the tax payable, right, then in that case you have to deduct the TDS also, advance tax also, from the tax liability of the company. But whatever the exactly amount which is payable by the assessee, in that case some information is given like dividend, right, on which it's given gross, but on which the dividend TDS must have been deducted. In that case 194 ke accordingly you have to provide the deduction in respect of TDS. TCS may, if the assessee has purchased a motor car or something, right, on which it exceeds the value of 10 lakh, then 2061F ke according TCS must have been collected from the person. So that collection amount has to be reduced while compute the tax payable amount. You have to note clearly what the question is required to you do. So that is a difference. The tax payable and tax liability are both the distinct things. You have to clearly note what the requirement of the question.
Prasad, you said you have some doubts relating to mock test paper April 22. You can raise your doubt. We'll get back to you tomorrow relating to that.
Now we are moving to our main provisions. Like I said, we are going to give you a quick revision of section 115 BAA or BAB. These are the concession tax regimes for the companies. So first of all, you should distinct from this what is section 115 BAA, किस पे लगता है, on what companies it is applicable, and who can claim the who can opt for this concession tax regimes. Both are there, but there is a difference of tax rates in both the things. So there are difference of deductions also. There are certain differences between these two tax regimes also. So those you have to keep in mind. First of all, don't get confused कि BAA किससे relate करता है, BAB किससे relate करता है. पहले तो sections को remember करना is difficult. कि BAA किससे करता है, because I sometimes got confused कि BAA किससे. Like मैं just a quick tip I can give you. Like BAA, it's alphabetically BAA already exists, right? BAB comes later. So the new companies, BAB relates to the new companies which are coming now. But the BAA is the earlier companies, also the existing companies. In that way, you can relate the section BAA relates to the existing companies, or the BAB are the new companies which are newly incorporated. So this is one way of remembering. When you are talking about the BAB and BAA, what are the crucial points you should note? See, BAB is applicable on for whom? It is applicable only for domestic manufacturing companies. Read the words: domestic manufacturing company and the electricity generation companies can only opt for this tax regime. However, BAA can be availed by any domestic company. Any domestic, not a foreign company, is any domestic company of Indian incorporated companies or any domestic companies. So those companies can opt for concession tax regimes given under section 115 BAA. Remember these sections, right? With the section numbers, you have to remember these provisions. There are distinct rates of tax are given in both the provisions. Here it's 22%. It's more beneficial. It's very lower rate of 15% is provided in BAB. It is restricted to certain only manufacturing companies or the electricity generation companies can avail this benefit. However, this can be availed by any company and the tax rate is 22%. And other special rates as provided under chapter 12. Chapter 12 contains the special rates, like in case of LTCG under section 112A, STCG, 111A, 112. There are many provisions which provide the specific rates which are not taxable as the normal provisions, right? Specific rates are provided under chapter 12. So if the company is having such income, that will be taxable at the special rates, or the other income will be taxable at the 22% rate. A rate of tax chart is being given in the next slides that we will discuss, and how to remember these rates that we will do. Rate of surcharge again is very important. Keep in mind, here the rate of surcharge is fixed. It's 10%, constant, it's 10%, not dependent on your turnover, right? While in case of normal provisions, the rate of surcharge is dependent on your turnover. If it exceeds 1 crore, it's 7%. If it exceeds 10 crore, it's 12% in case of domestic companies, right? it's 10%. Here it is fixed, irrespective of its total income, right? It's irrespective of its total income of the company. It's turnover. Its effective rate of tax. What is it then? The effective rate of tax, it's tax at 15%, surcharge at the rate 10%, and SHEs, here fixed rate of surcharge will be applicable, whatever be the type of income, whether it's LTCG, whether it's income from the manufacturing company, manufacturer, or from the whatever be the income of the company, everything will be subjected to surcharge. All that, everything will be subject to surcharge. So effective tax rate would comes to 17.16%. In this case, the effective rate is 25.168%. MAT, I already told you that where the company is opting for these concession tax regimes, then they need not to pay tax as per MAT provisions. So in both these cases, these are similarities. Both these cases, MAT is not applicable. There is distinct, it's applicable for domestic manufacturing companies or electricity generation. Here, any domestic company can claim 15, 22% or 30%, and special rate as specified in chapter 12. These are the specific rates that you have to remember, what rates are applicable on what type of income. Yeah, right. And rate of surcharge is again very important. What are the other conditions which the company has to fulfill to avail the concessional tax rates? What are these conditions? You have to read these conditions. You have to remember these conditions, right? That these companies should be set up and registered on or after 1/10/2019. The company should be set up and registered on or after 1/10/2019. और यहाँ पे क्या है, there is no time limit. I already told you these are for the new companies. So those companies which are set up and registered on or after 1/10/2019 are eligible for 115 BAB, whereas BAE can be opted by any company, right? Then this is not that much relevant for you as of now, because it's already assessment year 22-23. You will be tested for assessment 22-23, right? Need not be a manufacturing company. यहाँ पे जरूरत नहीं है that the company is a manufacturing company, right? Just a minute. Then it should not be formed by splitting above deconstruction of business already in existence. यहाँ पे it should not be formed by splitting up of the business, and it should not use any machinery or plant previously used for any purpose. It does not use any building previously used. If the company is using such facility, such old machinery or the old building, then in such case the company would not be eligible for 115 BAB. This is very important. You should keep in mind, it should not be engaged in any business other than the business of manufacturing. If the company is engaged in any other business other than manufacturing, then the company would not be eligible for section 115 BAB, right? But even then, the company has the option to claim the concession tax design given under section 115 BAA. Now tax rates, because there is mainly we get confused, students get confused ki what tax rate has to be applied on what type of income. This is very important. So BAB mein aap dekhiye, you see there are 4 types of rates are being given. It's 15%, then special rates, then 22% and 30%. 4 rates are given. 15% kab lagega? When the 15% rate is applicable? In respect of income, which is from manufacturing or production or generation of electricity, right? From that income means business income. Okay? Because only a manufacturing company can claim this tax design. The income derived from the manufacturing activity, on that income, 15% rate will be applicable.
Yeah, only one thing to note is that for manufacturing, that's the only business you can carry. You can't carry for any other business, but you can have other income like long-term capital gains or short-term capital gains, which will be chargeable to tax at the special rates which are provided. Right? That is there. Business, you cannot have any other business apart from manufacturing. If you have a trading business or something, then automatically you will go under 115 BA.
Yes. So special rates, I already told you, if the company is having, of course, LTCG the company can have, the STCG also company can have. If the company is having such incomes, those will be taxable at the rate specified under chapter 12, right? Then you have to, separate that income. Business income, LTCG income, STCG income. Then the other incomes, like income from house property can be there, income from other sources can be there, dividend income can be there. That income will be taxable at the rate 22%, right? Or this 30%, this is again very important. 30% कब लगेगा? आपके सारे इनकम तो टैक्सेबल हो गई यहाँ पे, ऑल द इनकम्स बिकम टैक्सेबल. आपकी योर इनकम फ्रॉम मैन्युफैक्चरिंग हो गई, स्पेशल रेट्स इनकम विल बी टैक्सेबल, अदर इनकम्स आर आल्सो टैक्सेबल. व्हेन दिस 30% rate will be applicable? This 30% rate will be applicable when the company is engaged into such transaction which gives rise to excess profits, right? If it derives excess profits from those transactions, on that excess profits amount, the tax rate is 30%. Suppose the company is purchasing from its associated enterprises, right? To take the benefit of 15%, what they can do, they can increase their profits also. To curb those practices, basically, they have given this 30% rate. If the company is purchasing from the this associated enterprises, right, at a price which is lower than the market ALP, which is lower than the arm length price, what it gives rise to? Higher profits. अगर आपका purchase कम price पे आपने purchase, if you have purchased the things at a lower price, it gives rise to excess profits. Then in that case, that income will be taxable at 30%. लेकिन you have to keep in mind कि अगर wherever you are applying the provision 48(2), where you are diverting your profits to the other entities, in that case what you do? You will increase, your purchases will make at a higher price. In that case 48(2) लगेगा, that section 48(2) will be applicable. You will disallow that expenditure to that extent. But यहाँ पे फिर 30% rate नहीं लगेगा. That 30% rate will not be applicable in such cases, right? So you have to distinct between, you have to note carefully where the transaction leads to excess profits. On that excess profits, 30% rate would be applicable. 4 rates for 15%, special rates 22%, 30% in case of BAB. यहाँ पे very important कि कोई deduction, no deduction is allowed in respect of such income. कोई और deductions नहीं मिलेगी आपको. No other deduction will be allowable in respect of such income. ठीक है? Like for example, house property है. हम क्या करते हैं? We know कि whenever the company is having income, we straightforward apply the gives the 30% deduction from that house property. So यहाँ पे 30% वाले deduction will also not be applicable if the company is having rental income, right? तो आप NAV your gross annual value निकालोगे, you will not going to provide you NAV में से no your 30% की deduction, no other deduction that section 24 will be applicable to that company. Like dividend के case में 20% to the extent of 20% of your this expenditure is allowable, right? So however, if the company is opting for this regime, there no deduction from those incomes will be available. It straightforward will be taxable at the rate of 22%.
Saurabh Sarkar, 34.32 is right, including surcharge and cess. But the thing is, it's only for that income in which you have from a related party transaction. If the income has been increased on account of such a transaction, you purchase at a lower rate, as she told you, and because of that, your income stands increased. To that extent of that income, the 34.32 rate will apply. It's inclusive of surcharge and cess. Okay, but whereas if you are going to apply 40A, that is my purchases from a related party is at a higher price and 40A 2 is being applied, then of course my income is not increased, my expenditure is increased in that case, so the 30% will not apply. I hope you people have got that particular point which Parna said is very important, you know, because in one of the exams it had come this particular point where they had asked for increase in purchases, then obviously 30% will not be attracted in such a case.
Yeah, definitely. But rate of surcharge is same for all the incomes. So first of all, what you do, you will compute the applying these rates, the tax you will compute on that tax, you will have to apply the surcharge rate, right? It is not dependent on your total income. The surcharge is not dependent on your total income, right? It will be straightforward 10%. First आप सारा compute करो all the tax according to these rates, then you apply the surcharge, then you come to the HEC 4%. Here only 2 rates, very easy to remember. 22% लगेगा यहाँ पे only 22% rate and special rates. So easy to remember. यहाँ पे there is no restriction on in respect of income, no restriction. Business income compute करने के there are certain restrictions are there that you cannot claim deduction in respect of certain things that we are what are those like for example additional depreciation. If the company has purchased, if the company is engaged into manufacturing business, right, the company is eligible to claim the additional depreciation in respect of plant and machinery. However, if the company is opting for BAA, it will not be eligible. The additional depreciation will not be allowable while computing the tax, while computing the total income as per 115 BA. Other restrictions are also there. You have to remember these. What are these restrictions? What are the deductions or allowances which are not allowable while computing the total income as per section 115 BAA? There are. But like in this case, you will not get the deduction in respect of such income, like house property will not get deduction. Here there is such no restriction. यहाँ पे आपको 30% मिल जाएगा, whatever be the deduction, you will get that deduction. And all the incomes will be taxable at 22% and special rates. Like what are the, how to remember? As of now, I have computed there are 11, deductions which are being disallowed. There are restriction on 11 deductions. Like for example, first is SHL. If the company 10A ki deduction will not be available. Chapter 6 se again, chapter 6 se nahi milega, but 2 will be eligible. 80 JJAA or 80 M will be allowable.
Saurav Sarkar's query is answered.
Yeah. So additional depreciation, again, you will not be eligible. If T-board contribution deposit amount to the NABARD 33AB will not be applicable, allowable. 33ABA site restoration account with deposit deduction in respect of site restoration account is not available. Payment to research association. If you are incurring, there are two type of things are there in section 35 in additional research expenditure, research things, that if the assessee is incurring the expenses themselves, right? 35(1)(1) is there, right?
1(4)
and 1(4) is there. In respect of those two things, there is no restriction. The company is eligible to claim the deduction. However, if the company is paying to the third person, right, the other person for doing the research or statistical research or whatever be the kind of research that is given in subsection, the subclauses. So clauses 2, 2A and 3. Restriction is there. You will not be eligible to claim the deduction in respect of those contribution or the amount paid to the other entities. 35(2A) will not be allowable. 35(2AB) in-house scientific research of the manufacturing company will not be allowable. 35AD, important, very important. 35AD nahi milega because it's possible that the question must be giving this 35AD wala investments and you will provide the deduction in respect to the capital expenditure. But for those capital expenditure, you will not be eligible for deduction under these things, but you will be eligible for claiming depreciation in respect of those assets, capital assets, if right, while doing this BA.
Aparna, just let's check about 35(2AB) because that is also in-house expenditure.
Yeah, in-house, yeah, it's national laboratory, but it's capital expenditure, I think, because revenue expenditure, if the company is incurring themselves, they will be. But वहाँ पे दोनों मिल जाते, both the things will be available. But earlier it was weighted deduction. The assessee is benefiting from those, but still there is. So this is the basic difference.
That's true, na, because otherwise in-house.
In-house hai, but still it is not allowable. If you are incurring capital expense, when you will be eligible, right? ठीक है, आपको मिल जाए, capital भी मिल जाए. But 35AD specific reference देखिए, if you 35(2AB) if you give a specific reference, then you will not be eligible. 35CCD, CCC, these are the deductions which you will not be allowable. So आपको you have to remember these things.
Generally, whenever there's a contribution, they are not allowed.
Generally. Yeah. In this way, you can remember these things. Now we can take you through one case scenario based, some case scenario based MCQs. We have one case scenario relating to this section. And I want you to answer this MCQs. It will give you a quick revision of your this 115 BA or BAB sections or some other sections also which are being dealing in this case scenario. So let me read this case scenario for you first. There is a Indian company, Yata Limited, set up on 1/10/2021. Right, for printing of books. For what? It's set up for printing of books. On the same date, it installed plant and machinery for 2 crore and put the same to use immediately. It employed 220 new employees on the set date at the rate 24,000 per month per employee. Their emoluments were paid by way of account paid check, and all of them participate in recognized provident fund. You have to read each and every word very carefully while answering any question. Okay? It's possible they will catch you in some of the sentences. So read each and everything carefully. There is another company, Shiva Limited, an Indian company, engaged in the business of generation of electricity. The company was set up on 1/4/2019 And on that date, it had employed 500 new employees, all of whom participated in recognized provident fund. The emoluments of these employees were paid by ECS through bank accounts, 17,000 per employee per month. For 160 employees, 21,000 per employee. And for 120 employees, it's 26,000 per employee per, right? It exercises options for depreciation on return down value method on block of assets. On 110, other information, the company installed new plant and machinery of ₹9 crore and put the same to use immediately. The company has received dividend of 60 lakhs from other domestic company during the previous year. Shiva Limited also distributes dividend of ₹72 lakhs for the previous year 21-22 in July 22. The gross total income for AY 22-23 computed in the special provision is given here. The gross total income is already given in the facts of the case scenario, right? When you are reading the facts of the case scenario, don't try to interpret, analyzing what type of question. First read the questions also, then again visit the case scenario and compare what are the questions requirement and which are the facts which are relevant for you to understand. Like first we read the question. यहाँ पे what is the first MCQ? First MCQ says which of the following statement is correct with respect to concession tax regime. यहाँ पे some statements are given relating to concession tax regime. कि what statements are correct, whether the Shiva Limited or Yatra Limited are eligible to opt for it or not eligible to opt for it. For that purpose, again we have to visit to the facts of the case scenario. See here, Yatra Limited is set up on 110/21. It is after 110/2019. It is of course set up. It's fine, and it's also manufacturing company, right? Manufacturing company hai ya nahi hai, that you have to know. It's printing of books. Some of the business are being said that they are not considered as manufacturing business for the purpose of section 115 BAB. What are those business? Let's see. Business of manufacturing here does not include the business of, there are 5 businesses are listed here. 6th one, abhi as of now, as such, not notified by the central government. What are these business? You have to remember, if the company is engaged in development of computer software, then it will not be considered manufacturing business. Mining will not be considered as manufacturing business. Conversion of marble blocks will not be. Bottling of gas into cylinders and printing of books. Here in the facts of the case scenario, the company is set up for printing of books is given. That is not considered as manufacturing business for the purpose of this section BAB के लिए. But again, you have to keep in mind PGPP में आपने देखा होगा, you have read the chapter PGPP. There is a circular number 15/2016 dating 19/2016. For the purpose of claiming additional depreciation, in that circular it mentioned that printing of business is considered as manufacturing, right? For the purpose of claiming depreciation, additional depreciation. But here they are denying it. So BA, you will not be eligible for section 115 BAB. But if the company is opting for normal provisions, then they can claim additional depreciation, right? This is the basic difference. So यहाँ पे क्या हुआ? This company will come out of the purview of this section 115 BAB. Straightforward. Next company का देखते हैं what information is given. That company is engaged in business of generation of electricity. Here in this section, generation of electricity is also one of the criteria for claiming section 115 BAB. So can it be? However, there is that the company was set up prior to 110/2019, so it would not be eligible for BAB again. So Shiva Limited will not also be eligible, and Yatra Limited will not also not be eligible. So whether they are eligible for section 115 BA, yes, because both are the domestic companies. This is one of the requirements. The domestic company can be eligible for section 115 BAA. So what are these statements? You have to carefully read these statements and accordingly choose one of the options from the given. First option, both Shiva Limited, Yatra Limited are eligible to opt for concession tax regime BAB. Abhi we have discussed that these are both are not eligible, so this is out. Then Shiva Limited and Yatra Limited are not eligible to opt for concession tax regime BAB में eligible नहीं है. This is the correct statement, right? कि both are not eligible. Both Shiva Limited and Yatra Limited are eligible for section 115 BA. That also we have decided. Both are domestic companies. They are eligible. So this also seems to be correct statement. Fourth statement is Yatra Limited is eligible to opt for BAB and Shiva is not. Already discussed that both are not. eligible, then Shiva Limited and Yatra are not eligible to opt for. Both of them can claim. So 2 and 3rd are become the correct statement, and answer is B. Right? The correct answer is B. What is the next question? Here it's saying if Shiva Limited and Yatra Limited opted for concession tax regimes, can they claim deduction under section 80JJA? I told you BAB में they are not eligible, right? हमें अब देखना BAA देखना है. We have to see the BA provisions. BAA में chapter 6 से deductions are not allowable except 80M or 80JJA, or 80LA also is there. If the company is located in IFSC unit and claiming deduction 80LA, then it will be eligible. But this is very this is also one of the things. 80JJA is something which is frequently asked. Basically 80M is also very frequently asked. 80LA also you have to keep in mind. If it is, then what would be the amount of deduction and available computing the total income for this assessment year 22-23? See, now what you have to do, they are asking you to compute the deductions, whether the deduction is available, they can claim 80JJ is available to both the companies, and what is the amount of deduction they have. Now you have to keep in, now you have to go through the section 80JJ provisions. What are these 80JJ provisions? Says 80JJ is available in respect of new employees, right? And 30% of the additional employee cost is allowable as deduction for the 3 assessment years, right? And whatever the amount payable to the additional employees would be considered as the emoluments. But there are certain conditions. What are the allowable additional employee cost consist of? Kya milega? What are the eligible conditions? Uske liye you have to see there are certain restrictions that additional employees kya comprise karega. Additional employees mein they have listed out many employees which are not considered as the additional employees for the purpose of 80JJA. Those things you have to remember. For this purpose of this case scenario, what information, what facts are being mentioned about the employees? Here, it set up on 11021. It employed 222 new employees. They employed also. The emoluments are less than your emoluments are less than your does not exceed 25,000. It's 25,000 or less are allowable. So their emoluments is 24,000. Their emoluments are paid by account paid check, and all the employees are participating in recognized provident fund. So eligible hai, but for this deduction, the employee should be employed for a period of 240 days, right? 240 days or more during the previous year. Here the employees are employed in 110-2021. So this condition the company is not meeting. In their companies will be eligible in the succeeding years, of course, in respect of those employees. But for the previous year 21-22, the Yatra Limited would not be eligible to claim the deduction under section 80JJ in respect of these 220 new employees, since they are not employed for 240 days or more during the previous year. 150 days condition is also there, but that condition, 150 days employment condition is also there, but that condition is in respect of manufacturing of apparel. If the company is engaged in manufacturing of apparel, footwear or leather products, then 150 days time period has to be seen. Here the company is engaged in printing of books, here, right? In that purpose, we have to see the 240 days. So Yatra Limited ko no deduction will be allowable. In case of Shiva Limited, the company employed, the new employees were employed in the year 2000, previous in 1920. For 3 years, you know, including the previous year in which the employees are employed, right? Plus 1920, 2021 and 21-22. This is 21-22. So 30% of those emolument costs incurred in the first year would be allowable as deduction this year. So what is that? Only the emoluments. If the emoluments does not exceed your 25,000, then those employees cost will be included. If the employees are participate in the recognized provident fund, that is included. These are the two things for this purpose, right? What are those employees? See, 17,000 we are paying for 160 employees. Yeah, we will consider this cost. We will consider 21,000 per employee cost for 120 employees. Then this is 26,000 per month. Per month employees for 200. This will not be considered addition for the purpose of computing deduction as additional employee cost, right? So how much it will come to? See, for 17,000 into 160, right? Then your 21,000 into 120 into 12 into 12. Yeah, into 12. This comes to 32. 3 crore 26 lakh 40,000 into 30%. Into
this is only for the first one, and then you have to add the second one also.
Achha.
17,000 into 160, 160.
Just a minute, I will show you. It's coming to, you do the calculations. See, for these two employees, the cost of 21,000 and 17,000 for 160 employees, and 21,000 into 120 employees into 12 for 12 months. You will
coming this one, 188,64,000.
So the allowable 30% of that amount, total employee cost ka 30% is allowable as deduction. It comes to 188,64,000, right? This is the correct answer for this. Allowable is deduction under section 80 JJ to Shiva Limited, and no deduction is allowable to Yatra Limited since the employees are not employed for 240 days. So Yatra Limited ko no deduction is allowable for this previous year. This is the 80 JJ provisions you have to know. Then what is the total income and tax liability of Shiva Limited? They are asking Shiva Limited ki total income and tax liability. If it opts for concessional tax regime, agar ye opt kare concession tax regime ke liye, ab what information is given in the facts? That in the facts it's given that gross total income as per the special provisions, means the concession tax provisions already being given in the facts. It's 7.2 crore of Shiva Limited is given.
Prasad, actually, first year only the number of days matters. You've asked about the employment cost eligible for 80JJ. That year of employment, they should have been there for 240 days. But of course, there's another provision. Suppose they are not there for 240 days in the current year, but in the subsequent year, they continue to be employed for 240 days. They would be deemed to be employed in that year. And from that year, the 3-year period for counting 80JJA deduction will arise. Okay, like for the company here, which was not able to claim reduction because of the employment being for less than 240 days. So the next year, if the employment continues for 240 days and more, then they will be eligible to claim in the next year, and that would be taken as the year of employment, and accordingly it will be available for 3 years. If you see this way, now the company benefits more because whatever deduction you get for the first year, the same deduction you will get for the second and third year. In the very first year, if you're employed for only 240 days, then you actually the remuneration for the 240 days only will be taken into consideration, or whatever days, 240, 270, whatever the number of days they employ. But the subsequent years, they'll be employed for the whole year. So the whole year remuneration will be the basis for, and 30%, and that will be allowed under 80JJA for the next 3 years. I hope your query is sorted out. So it's very much relevant for the very first year.
Yeah, yeah. In the succeeding from that year, the 3 years period will be counted then. 30 years, 30%. Yeah. Here the Shiva Limited gross total income is given 7.2 crore. Right. Isme se whatever the deduction 80JJ already be computed. It's 1.8864 80JJ deduction. Milega eligible. What other deduction the company will be eligible? What facts are given in the case scenario? It's relating to dividend income. See, 80M deduction is allowable to the company. Why? Because the company has received 60 lakh rupees during the year, and it also distributed 72 lakh rupees. So how much is the deduction allowable in under section 80M? It's whichever is lower, means the amount which is received or the amount distributed, whichever is lower is allowable as deduction to the company. So company has received 60 lakh rupees and 72 distributed, 60 lakhs deduction the company will be eligible. Okay. So यहाँ पे 60 lakhs का, sorry, it will come to 4.7136. अभी यहाँ पे company का what are the incomes? Nothing is given. We assume कि it's the income from only manufacturing. So straightforward, we will apply 22% plus 10% surcharge plus 4% education cess. it comes to 4. You have, if it opts for concession tax resigns, total income is 47,136 and 1,863,190 would be the tax liability. In this case, two things: ATJJ already we claim computed in the second MCQ. The ATM also you have to consider while computing the total income of the company and accordingly apply the tax rate. This is an easy question.
Saurabh Sarkar, set of provisions, if to the extent it relates to all the deductions which are not allowed, that will not be allowed to that extent. Okay.
Yeah.
I hope everybody is following. Actually, we are getting queries from limited number of students. So if any of you have any queries relating to whatever we are taking, please raise your queries.
Yeah.
So that we are able to answer it on that.
Then the Yatra Limited, what would be the tax liability of Yatra Limited? GTI of Yatra Limited is also given in the question. Facts mein, you go to the Yatra Limited mein, what information is given? Company is not eligible for ATJJ. Nothing is not eligible. ATM ke respect mein, there is no information for Yatra Limited. So whatever is 1.3 crore is the GTI will become your total income. Accordingly, you compute here 22% again, then 10% surcharge, then 4% HEC. Accordingly, you can compute the tax, and as per the applying these things, the option A would become the correct option. This is would be the correct option. This is very easy. Then what would the total income of Shiva Limited and Yatra Limited computed as per the normal provisions? They wanted to compute the total income of both the companies as per the normal provisions. What are the distinctions here? Basically, the company has installed, both these companies installed new plant and machinery, right? In respect of new plant and machinery, companies ko, while compute the concession tax regimes also, normal depreciation must have been provided. But if here the total income is computed as per the special provisions. In such case, the additional depreciation in respect of these machineries are not being provided. That what you have to do? You have to provide for these additional depreciation for computing the total income as per the normal provisions. 7.20 mein, first of all, both the Shiva Limited ke case mein, both will be eligible. ATJJ, ATM provide karenge. Then what you do, other provide additional depreciation in respect of plant and machinery. The company has installed plant and machinery of 9 crore. 9 crore ke liye and put you to use immediately, right? So 9 crore pe 20% you will be eligible. 1.8 crore ka. From this total income, 7.20 minus ATJJ deduction, ATM deduction, and this 1.8 crore. Accordingly, 2.91 crore would be the total income of Shiva Limited. And in case of Yatra Limited also, this would be eligible. It also installed plant and machinery for 2 crore during the year. 2 crore pe, it's put to use for more than 180 days or more during the year. So yahan pe 2 crore pe we will apply 20%. It's coming to 40 lakhs. Then 40 lakhs deduction will be allowable from 1 point to 90 lakhs would be your total income of Yatra Limited as per the normal provisions of the answer. Accordingly, the answer would be A is the correct option in this case. So this is about the provisions of section 115 BAA and BAB.
So you just see how many provisions were involved here. You had to provide for ATJJ, you had to provide for ATM, you applied those provisions, additional depreciation, how the definition of manufacturing itself was different for the purpose of additional depreciation for the purpose of 115 BAB, which is what disentitled the company from opting for 115, because printing of books is specifically mentioned as not constituting manufacturing there, whereas for the purpose of additional depreciation, there was specific circular clarifying that it is entitled to. So it is very interesting. At the same time, you must know all the finer points to be able to answer the question correctly. Particularly, I'm telling this because there was one student who asked about, Saurabh Sarkar asked about MCQs. So you can see this MCQs itself involves application of multiple provisions. So the more you practice, the more you will get confident about attempting such questions which involve application of multiple provisions. Even a small mistake, even if one provision you had omitted to attempt, suppose you had failed to notice that printing was not manufacturing, the whole answer would become wrong, no? Because you would have ended up applying 115 BAB instead. So everything would have gone wrong. So these small things matter a lot. Very much, whether you are attempting descriptive or MCQs. In MCQs, because you will have various options, wrong options which match the options which you'll arrive at if you miss out some important provisions. So kindly keep all this in mind.
Yeah, this is about the these provisions. Now we can move to our give a quick revision of REITs, investment funds, and securitization trust. When we may start. Yeah.
Can we switch to PDF?
Yeah.
If you touch the, yeah. I hope the screen is visible to you all. These are the special provisions incorporated in respect of REITs, investment funds, and securitization trust, which you can get for an 8 marks question, or you can get it by way of a case scenario. Okay, and what happens, students get confused, because these there is a trust, there are unit holders, REIT, investment fund, and there are some income which are taxable in the hands of the trust, some income are taxable in the hands of the unit holders. Wherever an income becomes taxable in the hands of the unit holders, a trust will be required to deduct tax at source. So these are different for these 3 types of things. Real estate investment trust is basically a trust which invests primarily in completed revenue generating properties. It can do so directly also, or through a special purpose vehicle, which is an Indian company. And that company invests in completed revenue generating properties. That is the structure of REIT. Now, as far as investment fund is concerned, it can be an SME fund, it can be an infrastructure fund, venture capital fund, private equity fund, debt fund, whatever comes in AI category 1 and 2 AIFs. Then the third is the securitization trust, which actually purchases the receivables of banks, financial institutions, and earns income out of the securitization activity. So as far as the tax paper is concerned, you are not going to be primarily going to be tested on the in-depth concepts involving REIT, investment fund, or securitization trust. Broadly, you should know what it is, but on the tax treatment primarily. What is taxable in the hands of the trust itself or fund? And what is taxable in the hands of unit holders? If it's taxable in the hands of the unit holders, what is the requirement of TDS in the hands of the trust? So we will see what is the finer points in these 3 entities. So first, let's take a real estate investment trust. As I told you, real estate investment trust invests in completed revenue generating properties, earned rental income out of that primarily, or it will invest in an Indian company, which is a special purpose vehicle, which will in turn invest in completed revenue generating properties. And then what will happen then? It will get, when it directly invests, it will get rental income in real estate properties. If it is going to invest through the special purpose vehicle being an Indian company, then when it has lent money to the Indian company, it will receive interest, or it will, because it has invested in the it holds at least 50% of the capital of the SPV, it will get dividend income also. So you can get interest income plus dividend income from the Indian company, which is the SPV. Plus, you can get rental income from real estate, rental income from properties directly lent out by it and owned by it. Okay, so these 3 are the primary sources of income. Apart from that, you have other income also from by way of long-term capital gains, short-term capital gains. You can have other income also. Now, which are the income which is taxable in the hands of the real estate investment trust? Which are the income taxable in the hands of the unit holders? As far as real estate investment trust is concerned, okay, there are 3 incomes for which it enjoys pass-through status. Those are the primary incomes which I've talked to you about the real estate investment trust. Rental income from letting out of property owned by it, that it enjoys pass-through status, taxable in the hands of the unit holders. Interest income from SPV, being an Indian company, that also REIT doesn't need to pay tax, unit holders have to pay tax. Dividend income from SPV, REIT does not have to pay tax, pass-through status. Investor, the unit holder, will also enjoy exemption in respect of dividend income if the Indian company has not opted for 115 BAA. Here it's a tricky point. The Indian company from which the REIT receives the dividend and distributes to unit holders, if that Indian company has not opted for 115 BAA, then what will happen? The the unit holder will also enjoy exemption from dividend income. But if it has opted for BAA, then it will become taxable in the hands of the unit holder. In either case, the REIT will enjoy pass-through status in respect of dividend income. So what are the three incomes? Rental income from real estate property directly owned by it, then interest income from SPV, dividend income from SPV. These three things the REIT enjoys pass-through status. But it is these, in respect of the first two, it is taxable in the hands of the unit holder. In respect of dividend, it will be taxable if the Indian company, being the SPV, has exercised the option under 115BA. Whenever it is taxable in the hands of the unit holder, what will happen? There will be some TDS provisions. The REIT will have to deduct tax at source. Now, what is the TDS provisions? If for rental income, as I told you, it is enjoyed for business trust, which is REIT, it's a pass-through status. So unit holder, it is deemed income, as I told you. Then the business trust has to deduct tax at source. 10% in case of a resident unit holder, and at the rates in force for a non-resident unit holder. What is the rates in force? If it's a foreign company, if the non-resident unit holder happens to be a foreign company, then it's 40%. Remember, in case of non-residents, you have to add surcharge if applicable plus cess also. It's not required for residents. For residents, TDS provisions, except for salary provision, other provisions, you need not include surcharge and cess. But whereas for non-resident, you will have to include surcharge and cess. Surcharge if applicable and cess. And for other non-corporate non-residents, it's 30%. That's the rate in force. Plus surcharge plus cess if applicable. Okay. Now come to the next one. Interest income from business trust. Here again, the business trust will enjoy pass-through status, and it is deemed income in the hands of the unit holder. This last column is for unit holder. Second column is for business trust. Okay. And this third column is for TDS, what the business trust has to deduct. Okay, 10% in case of resident payee and 5% in case of non-residents and foreign companies. Add surcharge and cess for non-residents and foreign companies, surcharge if applicable. Then dividend, again for business trust, it's pass-through status, and where the Indian company, being the SPV, has not opted for BAA, it will be exempt in the hands of unit holder. Once it's exempt, there is no requirement of TDS. But suppose it's taxable in the hands of the unit holder, then the dividend has to be, business trust has to deduct tax, 10% common for resident and non-resident payees. So you can see wherever tax is deductible for resident, in case of REIT, it's taxable. I mean, the TDS rates apply at 10%. It's uniform. For non-residents, it's varying. It's at the rates in force for rental income. For interest income, it's 5%, and for dividend income, it's 10%. Plus, you have to include surcharge if applicable, and plus cess at 4%. All other income will be taxable in the hands of REIT. Only in this respect of these three income, which are the primary income of REIT, it enjoys pass-through status. In respect of all other income, REIT has to pay tax in its own hands. If it's in the form of LTCG under 112, the rate at 20% will apply. STCG under 111A, in respect of listed shares, units of equity-oriented fund, units of business trust, then it's 15%. In respect of all other income, it's taxable at MMR, that is 42.744%, which comes as 42.74%. You will come applying 30% rate plus 37% surcharge plus maximum surcharge plus 4% cess. You will get 42.744. Here you can see one thing is left out. What about LTCG under 120? Will that also be charged at MMR? Because here I mentioned only LTCG under 112 and 111. Actually, Act specifies like this, but I think the intent has to be that LTCG under 112A also has to be subject to tax and the special rates, because this section came later. Probably it was an accidental omission. So that also should be chargeable to tax at 10% in excess of 1 lakh as specified in that section, and the remaining income will be chargeable to tax at MMR. In respect of these incomes, of course, because the REIT is going to pay tax on it, it will be exempt in the hands of the unit holder. And since it's exempt in the hands of the unit holder, TDS provisions will not be applicable. I hope. Yes, Saurav Sarkar, you are right. STCG and development property will be chargeable to tax at 42.744. Yes, right. Prasad, are you talking about these three provisions or you're talking about general TDS provisions? These three TDS provisions I'm covering simultaneously. Other TDS provisions we'll be taking up tomorrow when we are doing the chapter on TDS TCS. That time we'll be taking up. But as far as it relates to these provisions, we'll be covering it here. Then investment fund. Next, I hope REIT is very clear to you. What is taxable in the hands of REIT? What is passed on to unit holders? What is the TDS requirements? Okay. Now in the hands of an investment fund. Investment fund, as I told you, it's category 1 and 2 AIFs, venture capital funds, SME funds, private equity funds, debt funds, infrastructure funds. These are all covered largely here. And PGBP, income at the hands of income under the head profits and gains of business and profession. That is taxable at fund level itself. Okay, it's 30% in case it's the fund is in the form of a firm, and company, whatever the rates applicable to it. For all the other forms, it's taxable at maximum marginal rate. Okay, and of course, this income is exempt in the hands of the unit holder. Then income other than profits and gains of business and profession. For that, the investment fund enjoys a pass-through status. Income other than profits and gains of business and profession. Taxable, it will be taxable in the hands of the unit holder as if he had directly made the investment. Okay. And investment fund will have to deduct tax at source, 10% in case of resident payee. Here again, kindly note, for resident payee, the TDS is 10%. For non-residents, it's at the rates in force. Again, if it's 40% plus surcharge and cess if it's foreign company, 30% plus surcharge if applicable plus cess in case of NCNRs. So it's 10% for resident payees. So far for investment fund and for REIT, the TDS is for residents is at 10%. It's the non-resident TDS which is undergoing changes depending upon the income. As far as investment funds is concerned, it's at the rates in force, 40% for foreign companies and 30% for other non-residents. Now, about carry forward and set off of losses. If loss under the head profits and gains of business or profession is incurred by the investment fund, then that loss will be carried forward because PGBP income is taxable at the hands of fund level. This loss will also be carried forward by the fund. It won't be passed on to the investors. Okay. Then what about other losses? Apart from PGBP losses, if there are other losses, in respect of those units which are held by the unit holder for a period of at least 12 months. If I've held the units for at least 12 months, then the unit holder can carry forward such losses, and the same carry forward and set off provisions as in chapter 6, whatever you learned before, like long-term capital loss can be set off against only long-term capital gains, short-term capital loss can be set off against both short-term and long-term capital gains. All those provisions will apply. Okay. Then if the units are held for a period of less than 12 months, then the unit holder cannot carry forward losses in respect of those units which are held for less than 12 months. And the act is also silent relating to whether it will be allowed as set off in the hands of the fund level itself. The act is not specifying anything relating to that. Okay. So this is as far as the investment funds is concerned. As far as the investment fund is concerned, only the PGBP income is taxable in the hands of the investment fund. All other income, it enjoys a pass-through status. It is taxable in the hands of the unit holders. And the application, the TDS is at 10% in case of residents, and at the rates in force in case of non-residents, that is 40% for foreign companies and 30% for other non-residents, including surcharge if applicable and cess at 4%. I hope this is clear for investment funds. Now we come to securitization trust. Securitization trust income from the activity of securitization is exempt in the hands of the trust. So it will be taxable in the hands of the investor as though they had directly made the investment in the underlying assets. Okay. Now, Two things which I want to tell you as far as securitization trust and as far as investment fund is concerned. If the income is not distributed to the unit holder, then what happens? If the income is not distributed to the unit holder, then it is deemed to have been credited to the unit holder as on the last day of the year, and accordingly unit holder will have to pay tax on that. Okay, but this provision is not there in REITs. In REITs, there is a requirement that the real estate investment trust distributes 90% of its income to the unit holders. Okay, but if suppose it does not distribute the remaining 10%, it is not deemed to have been credited. That provision is not there in REITs. Whereas the provision is there in investment funds and in securitization. If the entire income is not distributed to the unit holders, it is deemed to have been distributed on the, it's deemed to have been credited on the last day of the previous year, and tax has to be paid. But if tax is paid in one particular year, then again on the year of actual distribution, tax need not be paid again. I hope this point is very clear. There is no deemed credit in the REIT provisions, but it's there in investment fund and securitization trust. Also, the TDS provisions here are slightly different. In case of resident individuals, because all income is taxable in the hands of the investor, in the hands of securitization trust. For resident individuals and HUF, there also they are making a bifurcation between residents. Individual and HUF means it's 25%. Resident pays other than individuals and HUFs, it's 30%. And non-corporate, non-residents and foreign companies, it's rates in force. Again, rates in force means 30%, 40% for foreign companies and 30% for other non-residents plus surcharge and cess. So this is slightly different TDS provisions as far as securitization trusts are concerned. I hope it is very clear. Okay, now we take a small example to understand the difference. Mr. Rajesh is a resident unit holder of investment fund and real estate REIT, okay, which holds 100% shareholding. The REIT holds 100% shareholding in GPL Limited, an Indian company. So GPL Limited is the SPV. Mr. Rajesh holds 10% units in both REIT and investment funds since the year 2019. 10% units he holds since the year 2019. Okay. Now income particulars are given. Okay. So this is the particulars of income which Rajesh has earned from REIT and particulars of income of REIT and investment fund. Okay, here they've given you particulars of REIT and investment fund. Okay, REIT dividend income is 2 crores, interest income, dividend income from SPV. This is the SPV. This is also SPV. Then short-term capital gains and sale of development properties. These three income are the income of REITs. And investment funds, also they've given 3 income, business income, long-term capital loss and interest income. So 10% is Rajesh's holding in REIT as well as in investment fund. Okay. They've given GPL does not exercise option under 115 BAA. This is the SPV. So that will determine the taxability in the hands of the unit holder. If the SPV does not exercise option under 115 BAA, the dividend income which the REIT has received from GPL Limited and distribute to unit holders will also be exempt in the hands of unit holders. That is one thing. Then the REIT and investment distribute 90% of its income to unit holders. That is given. Okay. Compute the total income and tax payable by Mr. Rajesh for the assessment year 22-23, assuming that Rajesh has opted for 115 BAC. Okay. Rajesh has opted for 115 BAC. Now, but this the GPL has not opted for 115 BAA. Just remember these 2 points. Now, what is Rajesh's share? It's 10%. It's already given in the question. Rajesh holds 10% units in both REIT and investment fund since the year 2019. So he's been holding it for 3 years. Okay. Now, in case of REIT, what will happen? Dividend income from REIT. Okay. 10% dividend income. It will anyway be exempt in the hands of unit holder because GPL Limited does not opt for 115 BAA. Had it opted for 115 BAA, then it would have been taxable in the hands of Rajesh, but it has not opted. So it will not be taxable in the hands of Rajesh. Okay. So this will not be taxable. It is exempt. Now, interest income from SPV, will it be taxable? Yes, because REIT enjoys pass-through status in respect of that investment income. So it will definitely be included in the taxable income of Rajesh. And since he's a resident, REIT will be deducting tax at source at 10%. Now, what is Rajesh's share? 10%. How much has REIT distributed? 90%. Okay. So 90% of 3 crores is 2.7 crores and 10% of 2.7 crores will be 27 lakh. So 27 lakh will be included in the income of Rajesh. You understood, na? 3 crores mean 90% income has been distributed. So 2.7 crores and out of that 10% will become 27 lakh. This is the income of Rajesh. Short-term capital gains on sale of development properties. Now, we know as far as REIT is concerned, only 3 incomes in respect of which REIT enjoys pass-through status, which is taxable in the hands of unit holder. Those are rental income from real estate property owned by it, interest income from SPV, which we've already discussed, dividend income from SPV, in which the GPL has opted for, if the SPV has opted for 115 BAA, then it will be taxable in the hands of unit holder. Otherwise, it's exempt both in the hands of the REIT as well as in the hands of the unit holder. In this case, since the SPV has not opted for 115 BAA, it is exempt both in the hands of REIT as well as in the hands of the unit holder. All other income is chargeable to tax in the hands of the REIT. So now the question asks for compute the total income and tax payable of Mr. Rajesh. So since this is taxable in the hands of REIT, it is the amount which is received by the unit holder will not be taxable in his hands. Okay. Now coming to investment funds. Now investment fund, we all know that business income of investment fund is taxable in the hands of the investment fund only. Fine. So it is not taxable in the hands of the unit holder. So this is taxable in the hands of the investment fund. Long-term capital loss. Long-term capital loss, it's allowable in the hands of the unit holder. That is Rajesh in this case, it's allowable. He's also held the units since 2019. So he's held it for more than 12 months. So he can carry forward the loss, but he does not have long-term capital gains this year against which he can set off. There is no income from long-term capital gains. So he has to carry forward this loss in his hands. Sorry. 1 second. Whatever his share will be. What will be his share? It will be 10% of 27 lakhs. Here I don't do 90%. I don't do 90% because whatever is the income, it is deemed to be credited on the last day of that particular year. Fine. Which provision is not there in REITs. Now interest income. Interest income is taxable in the hands of the all other income except business income is taxable in the hands of the unit holder. So 52 lakhs is taxable. And since the share of Rajesh is 10%, even though only 90% was distributed on the entire 52 lakhs, the remaining 10% is deemed to have been credited on the last day of the previous year. So 52 lakhs ka 10%, 5.2 lakhs will be chargeable to tax in the hands of Rajesh. So what is chargeable to tax? 27 lakh here and 5.2 lakh. Totally 32.2 lakh will be Rajesh's total income. Is this very clear? I hope this is clear. $32 lakh 20,000 is the total income. I hope there is no doubts relating to this. Now, how do you compute tax payable by Rajesh? It's given Rajesh opts for 115 BAC. Slab rates for 115 BAC are different from the normal slab rates because these are concessional provisions on which no other benefit is given. So how is it? Up to 5% it is the same. Okay, this is the same under regular rates also. Okay, but after that, for each 250 increase in 250,000, the rate of tax increases by 5%. For each, see, 250 to 5 lakh is 5% under both normal tax regime and special tax regime. But in special tax regime, thereafter 5 lakh to 7 lakh 50,000, it's at 10%. Percentage increase is 5%. 7 lakh 50 to 10 lakh, again 2 lakh 50,000 slab, again 5% increase. 10 lakh to 12 lakh 50,000, 20%, again 5% increase. 12 lakh 50,000 to 15 lakh, again 5% increase. 15 lakh, over and above 15 lakh, it's chargeable to tax at 30%. I hope this is very clear. So up to this, it comes to 187,500. Okay. Then after that, if your income falls in the 30% slab limit, till 25%, you can take the amount as 197,500. And 30% of the amount in excess of 15 lakh, your tax, it will come to 5,16,000. So it's 7,03,500. You add cess, and this will be your tax liability, 731,640. Now, this is not the end of the answer. The question requires for tax payable. Initially, we had told you, now you have to know to, suppose it had been tax liability, you could have stopped with this also. It is tax payable. So I have to reduce the TDS part of it. The REIT would have deducted tax of 10% on interest income. Interest income is 27 lakhs, which you had included. 10% is the TDS rate for residents. For both, in case of REITs and investment fund, for all income of residents, it's 10%. So 10% of 27 lakh is 2,70,000, and investment fund 10% of 5,20,000 is 52,000. So it's 3,22,000 TDS, which has been deducted to the and would have been credited to the Mr. Rajesh's account. I have to deduct that, and 409,640 is the net tax liability, net tax payable. I hope this is very clear. This is very important. This step students are likely to miss out also. You might compute till this, but that is not the end of the answer. You should, that's why the TDS provisions I discussed simultaneously, so that you know that if tax has to be deducted by the REIT and by the investment fund, then in the hands of the unit holder, the tax credit has to be given when I'm computing my tax payable.
Yeah, this is good question. Saurav sir can ask.
115 BAC, see, there is no benefit for the senior citizen. Higher basic exemption limit is not allowed. So if 2,50,000 will remain 2,50,000 even if he is of the age of 60 years, even if he is of the age of 80 years. Under normal provisions, it's available. Under special provisions, it's not available.
Yeah.
So I hope you've understood the provisions of special provisions relating to REIT, investment fund, and securitization trust, and the finer differences between the two. Remember, the important difference is the deemed credit on the last day. That deemed credit, if it's not distributed, that is there in the hands of investment fund and securitization trust. It is not there in the hands of REIT. And by chance, if the question doesn't specify what is the amount distributed, like it happened last time in the exam, it didn't specify that normally 90% has to be distributed in the case of REIT. They have not specified the percentage. If no percentage is specified, then you assume that 100% is distributed. Okay? Yeah. Saurabh Sarkar, you asked 80 days for leather company, it should be 150 days.
Yeah, for leather companies, it's 150 days. Yeah. Now we are going to proceed with the major amendments in section 1. Let's take some of the questions relating to Shiva Limited. Saurav, you have mentioned that it's an electricity company, so rate will be 17.16%. See, it's electricity company, of course, but it was set up before 1/10/2019. So it would not be eligible for 115 BAB, right? So it's 22%. Still, it's electricity generation company, but you have to see the setup date also. Right? Now we are going to take some amendments. First is relating to section 1010D and 45(1). These sections you have to read together to determine the net effect. Actually, you know that section 1010D. Section 1010D provides for exemption in relation to life insurance policies, right? If the annual premium does not exceed 10%, here it's 15% also, or 20% may also be possible, as the case may be, of the sum assured. Right? If the annual premium does not exceed 10% of the actual capital sum assured, then in such case, exemption is provided under section 1010D. But likewise, we will cover section 80C also. In actually, what is happening? There are ULIPs also eligible for these exemptions. ULIP is unit-linked insurance policies. Basically, it has a component of both investments and the insurance. In order to deter the higher net worth individuals for claiming such exemptions, means they are investing in the market, right? They are doing the investment through these ULIPs and getting the full-fledged exemptions. In order to catch those high net worth individuals, these exemptions provision are being amended to tax ULIPs with higher premium, that is of 2,50,000, exceeds higher premium of 2,50,000. Those ULIPs ke liye exemptions provisions are not available. What are those provisions? Actually, we have to, see the holistically, basically. See, what are the exemptions provisions in respect of ULIPs or the other life insurance policies, and what are the taxable provisions which are being incorporated this year. And there is one more thing in relation to life insurance policy, that is deduction under section 80C. All these things has to be read together. Another thing is TDS provisions also under section 194DA. These things you have to see. We have made a chart here to give you overall brief of these, all the provisions together. I think it's visible to you. In this chart, we are going to discuss the taxability, how the ULIPs or the life insurance maturity proceeds would be taxable. See, maturity proceeds pehle tha exemption se 1010D mein, but now some taxability provisions are being incorporated also if the conditions are not satisfied given in section 1010D. What if we are distinguishing between both these ULIP? First, hum dekhte hain it's life insurance policy or it's a ULIP. First, let's see. If it's a life insurance policy other than ULIP, what is happening? We have to see the premium amount. If the premium amount exceeds 10%, 15%, and 20% of the sum assured, 10%, 15%. In case of handicap, 20%, 1/4/12 se pehle ki the policies which are being issued on before 1/4/2012, in such case 20% of the sum assured, and other policies 10%. If the premium amount exceeds, annual premium you have to see, if the annual premium exceeds the sum assured amount, then what will happen? That maturity proceeds would be taxable. That means exemption available under section 1010D would not be allowable. And that proceeds would be taxable under the head other sources. Right? If it does not exceed, if it's 10% or less than 10% of the premium amount is, then exemption will be available in respect of life insurance policies other than unit-linked insurance policies. And what is the tax treatment in case of ULIPs now? What is the tax treatment? In case of ULIPs, unit-linked insurance policies, there is these dates you have to carefully note in the examination. What date is given in respect of those ULIPs? If the policy is taken before 1/2/21, 1st February 21 से पहले की policies हैं, if the policies are taken before 1/2/21, then the same treatment as we have given to the life insurance policies. That means you have to see the premium amount with respect to the sum assured. Now the different treatment is provided in this year. If the policy is taken on or after 1/2/21, if the policy is taken on or after, on also you read it, right? Read these words, on or after 1/2/21, then what is the treatment? You have to see the premium amount. What is the premium? If the premium amount in respect of those policies does not exceed 2,50,000, then we will go again to this part. And if the premium or aggregate of premium exceed 2,50,000 in any previous year during the term of the policy, then what you will do? In such cases, if you are having a single ULIP, you will know its premium exceeds 2,50,000 rupees, then that ULIP will be considered as capital asset. Different way of taxability is provided in respect of those ULIPs. These ULIPs are considered as capital asset for the purpose of computing income, charging income as capital gains. Then, and another important thing, the maturity proceeds, not maturity proceeds, you have to compute the capital gain amount on those ULIPs, considering as a capital asset. And that capital gain would be chargeable to tax under section 112A. 112 relates to the listed equity shares, the long-term capital gains, taxable under section 112A. In respect of those listed equity shares, 1 lakh exemption is there, and exceeding amount 1 lakh is chargeable to tax at the rate 10%. So the maturity proceeds, we are not going to tax the maturity proceeds, we are going to tax the capital gains. How will you compute the capital gains in such case? capital gains would be computed by maturity proceeds. Whatever the maturity proceeds you received minus aggregate of premium paid during the policy. The whole all over premium, whatever premium you have paid during the policy, you have to deduct it, right, from the maturity proceeds to arrive at the figure of capital gains. And that capital gains again would be taxable as long-term capital gain under section 112A. If the person is having multiple ULIPs, suppose if the person is having multiple ULIPs and the annual premium of some of the ULIPs does not exceed 2,50,000 of the proceeds does not exceed 2,50,000, what they can do? There are many policies of 1 lakh premium, 1,50,000 premium or something, again 1,50,000 premium. Then you have to have the option to claim the exemption in respect of the policies on which capital gains is higher. You know what would be your maturity proceeds. Somehow you will able to know what would be the maturity proceeds of such ULIPs. In respect of those ULIPs, you can take a decision. In respect of these ULIPs, it would be beneficial for me to claim the exemption. Kaise? For example, I will discuss this, that how you will take this option, how will you take the benefit of these, opting the, give the option to take the benefit of exemption. So exemption can be claimed in respect of those ULIPs at the option. Its option is given to the assessee whose aggregate premium, means combining the two policies or three policies, if the aggregate premium does not exceed 2,50,000, and premium amount should also not exceed 10% of sum assured, then in such case exemption can be claimed in respect of those policies. Remaining ULIPs, the other ULIPs, if a assessee has claimed, suppose in respect of 3 ULIPs, the exemption is being claimed by the assessee, then the 4th ULIP again exemption will not be available for in respect of 4th ULIP. That 4th ULIP will be taxable in the same manner as in case of single ULIP we have discussed under section 112A. This is the thing. In stat update, the guideline circular is given. So you go through, there are many examples are be given in case of single ULIPs. The example are given, and the multiple ULIPs. There are certain situations are be given in that stat update. You should go through that stat update, and from this you will come to know. We are going to discuss this case scenario, which is given in your RTP. You must have solved it. Let's quickly revise these provisions of ULIP, taxability of ULIPs or the other life insurance policies with the help of this case scenario.
In this context, I would just like to tell you RTP for May 2022 and November 2022. Both are very important. Both you should do, not only November 22, May 22 also, because the assessment year remains the same. Do both the RTPs very thoroughly, because all the amendments are more or less covered. Significant amendments are covered in both the RTPs. Previous year's RTPs, you can avoid doing it, because otherwise, even if you're doing it, you have to keep in mind the amendments which have taken place. Every year it changes a lot. But May 2022 and November 2022 RTP are very, very important.
Yeah, Yogesh asked, relating to exceeding TDS of 20,000 is required to file compulsory to, yeah, this amendment, this notification is there. That notification is given in your RTP, that where the cases where the assessee is required to mandatorily file a return of income if the TDS or TCS amount exceeds the particular threshold limit. So you go through that stat update. Stat
update has been posted to the BoS knowledge portal, where all these amendments are covered.
Now let's take this case scenario. Mr. Manoj is a resident Indian who has the following life insurance policies, some of which are being given here. The A policy, name of the policy is A, B, C is the ULIP, D is ULIP, E is ULIP, and F is ULIP. So these two policies are the normal life insurance policies, not considered as ULIP. What are the date of issue? You clearly note down the date and the maturity proceeds, what is the capital sum assured. All these information is very important to answer the questions. So very minutely check the dates, because sometimes what happens now in a mind ki ULIP hai, so it will be taxable. Hoga. As in, you have to see the date when the policy is being issued. Yeah, date is very relevant for you.
Because the new provisions are applicable only in respect of ULIPs issued on or after 1/2/2021. Yeah. So all these comparisons which you have to make are in respect of those ULIPs only, not the ULIPs issued prior to
this. Yes. Prior to this के लिए same treatment as given for the other life insurance policies, the same treatment will be given for those ULIPs also. So date is very relevant. This first A policy is issued on 1/4/2014, B is 15, C policy was issued on 1/2/21. This is 1/2/21. आपके new amendments में it's covering. It's issued in 1st January prior to 1/2/21. So normal treatment होगा यहाँ पे. Then the E is 1st March 21 and it's 1/4/21. So these three, this one, this one, this one. In respect of these ULIPs, the assessee has to take a call. In respect of which ULIPs he should claim the exemption and what other ULIPs can be given for, the maturity procedure is can be given as capital gains and make it taxable. So what is the annual premium in respect of those policies? 50,000, 40,000, 1 lakh, 3 lakh. This is the annual premium is given. When is the date of premium? This is again is very important for the purpose of computing not only the capital gains, for the purpose of section 194 DA also. DA is 194 DA is life insurance policy के respect में TDS in respect of life insurance policy maturity proceeds. If it is not exempt under section 1010D, then TDS has to be deducted and the maturity proceed should not be should exceed 1 lakh rupees, right? In such case, TDS provision would get attracted. So for that purpose also, you have to compute the whatever be the amount of annual premium. That date is also again very important when the date of premium falls and what is the maturity date. These dates are given. Consideration received on maturity, including bonus, is also given here, right? Then the sum assured is given. Sum assured plays a very important role while deciding the exemptions provisions, right? Or deductions under section 80C also. 80C deduction in respect of 80C ULIPs ke respect mein deduction is also allowable. For other life insurance policy, deduction is allowable. To what extent deduction is allowable? To the extent of 10% or 15% or 20% of the capital sum assured. The deduction has to be restricted under section 80C. So there is no distinction in allowing the deduction in respect of ULIP or other policies. Deduction provisions are same, but the taxability provisions are distinct for ULIP or other policies. First, we should read this. Other information relating to Mr. Manoj is also given that he had earned dividend income of 12 lakh from shares of Indian companies and gains, long-term capital gains of 5 lakh on sale of land. He deposited 1,50,000 in NPS on Tier 1 account. Mr. Manoj does not opt for section 115 BAC. This information very important. You should again visit the question, see what is the information given in the question. If question does not specifically mention whether it's opt or not opt, then you have to make a comparison. I think you have to make a comparison between both the things, right?
Which is more beneficial.
Now, before analyzing more on the facts, we should move to the question MCQ.
One page is blank, I think.
Yeah. Yeah. यहाँ पे what is the question? Which are the life insurance policies excluding ULIPs? There are two policies, A and B, other than the ULIPs, in respect of which Mr. Manoj would be eligible for exemption under section 1010D. In respect of maturity proceeds and what is the quantum of deduction which would be available under section 80C, right? For the assessment year 22-23. This is again important because certain policies are such which are ULIPs, which are matured in the other assessment years. You have to provide the solutions for the assessment year 22-23. So you see, you have seen that. यहाँ पे for the purpose of answering this question, you should assume that he does not have any ULIP. उसके पास कोई ULIP नहीं है. Why? Because 80C के लिए both the ULIPs are eligible, right? ULIPs and other policies are eligible for deduction, but here you have to compute the deduction in respect of other than ULIPs policies. यहाँ पे आके
this is a specific requirement only for this MCQ.
Yeah. Now let's see. In respect of A policy, the annual premium is 50,000. What is the capital sum assured? Capital sum assured is 6 lakh. 6 lakh at 10% is 60,000. it is meeting the criteria of 10%. It does not exceed the 10% of capital sum assured. Here, the capital sum assured is 3,50,000. 10% of it's 35,000. Right? 10% is 35,000. However, the premium is 40,000. So, policy A ke liye, this policy maturity date is this year, 31/3/2022. So, it would be taxable in the assessment year 22-23. And this is also matured on this year, right? Now, you know that its premium does not exceed 10% of capital sum assured. This policy A would be exempt. However, policy B, since the premium exceeds 10% of the capital sum assured, it would be taxable. ATC ke respect mein, in respect of ATC ke how much deduction will be available? In respect of this 50,000, he would be eligible for deduction. Policy A ke liye plus iske liye how much it has to be restricted to 10% of the sum assured. So the amount, how much it would be? It's 50,000 for policy A and 35,000 for policy B. The deduction under section 80C would be available for the assessment year 22-23. Other are also eligible, but for in respect of these policies are only asked in this question. So what would be the correct answer? It's only A. Answer would be only A is eligible for exemption, and deduction under section 80C would be 85,000.
Prasad, we are solving that next. 45, 4 and 9.
Now, what is the second question? Which are the units in respect of which Mr. Manoj would be eligible for exemption under section 1010D in respect of maturity proceeds? Choose the option most beneficial to Mr. Manoj. अब ULIPs के respect में this question is asking कि which are the ULIPs in respect of which Mr. Manoj would be eligible for exemption. Let's see what are these ULIPs in respect of which Mr. Manoj can claim the exemption. See, it's 1 to 221. इसके लिए we have what we have to see. The premium is 1 lakh. Premium 1 lakh hai, it does not exceed 2,50,000, but it has the Manoj is having other policies also. Then he has to opting for the exemption. He has to combine the policies before claiming the exemption in respect of directly to this only this ULIP, right?
The manner most beneficial.
Yeah, this ULIP D is what? This is prior ULIP 1 to 21. So it is already it's eligible for exemption. आपको इसके लिए क्या करना पड़ेगा? What you have to do? You have to make the comparison for capital sum assured. Capital sum assured is sum assured is 30 lakh. 10% of 30 lakh is 3 lakh. So the annual premium does not exceed 10% of. It does not exceed 10% of sum assured. It would be exempt. This ULIP is exempt. D is exempt. C के लिए 1 lakh है. It's 1,40,000. ये directly 2,50,000. अब directly 2,50,000, it is not exceeding 2,50,000, right? But तीनों का sum, if you do the sum of all the threes, it exceeds 2,50,000. So it has, Mr. Manoj has to opt for those policies whose premium, aggregate premium does not exceed 2,50,000. If you combine all these C, E or F, then annual premium exceeds 2,50,000. So he cannot claim the exemption with respect to all these three policies. Then you have to take a call कि what policies. It's 1 lakh premium, it's 1,40,000. इनको दोनों combine करते हैं, then इससे पहले what you do, you should compute the capital gains, not the maturity proceeds, not go by the maturity proceeds. कि maturity proceeds के 11 lakh आया, इसके 17 lakh आया, इसको 28 lakh आया. इन दोनों को combine करेंगे, it's 28 lakh. यहाँ पे singly it's 28 lakh. So again, you are in doubt कि वो which policy has to come, because the maturity proceeds are same. You have to compute the capital gains amount, right? Here what is the annual premium? Now you have to compute the annual premium amount. कितना premium इसने pay किया all over the policy? कब से इन्हें policy purchase करी है? 121 से purchase करी है, and policy date of maturity is 31/30, right? So अब यहाँ पे we have 9 years. Yeah, it's coming. Everything is for 9 years. Yeah, everything is 9. Yeah, this is also for 9 years. यहाँ पे it's also for 9 years, and it's also for 9 years. So when you do the computation, the amount comes to 9 lakh. And यहाँ पे I'm solving it. 9 lakh. It's coming to 2 lakh. ठीक है? Then here it is annual premium is 1,40,000 into 9. It is coming to 12,60,000. Then the capital gains would be 4,40,000. Here, if you do the computation, 2,50,000 into 9, it is coming to 22,50,000, and your amount would comes to 5,50,000. Okay. Now, in दोनों को if you combine, the amount comes to 6,40,000.
This is the capital gains.
Capital gains amount.
Amount which is going to be taxable if those ULIPs become taxable.
Yes.
That is the reason.
This amount is coming to 5,50,000. Which is beneficial. 6,40,000 is beneficial to claim as exemption instead of this F ULIP. If you see 28 only, यहाँ पे making comparison is difficult, or you have to compare with the capital gains amount, right? So in that case, what is the which are the policies in respect of which Mr. Manoj can claim exemption? Is C के लिए beneficial. Beneficial, I am talking. C के लिए he can claim the exemption, and E के लिए claim the exemption. D is also eligible for exemption. D के लिए also can claim exemption. It does not exceed 10% of this. So C, D, and E के लिए he can claim exemption.
D is anyway issued before 1/2/2021, so you need not apply these provisions at all. They just have to fulfill that 10% criteria. Otherwise, you need not see any. That 2,50,000 limit does not apply for D because it's issued before 1/2/2021. So D ka exemption is fixed. For out of, you have to see whether C plus E or F. So in C, if you choose C plus E exemption, then 5,50,000 will become taxable if you claim these two as exemption, C and D. If you claim F as exempt, then 6,40,000 will become taxable. So it makes more sense to claim C and D as exemption because your capital gains, which is taxable, will be lesser.
Yeah, this is the thing. So next question is also relates to you have to compute. Let's go to the question again. Here. Considering the option chosen in MCQ2, you already CD. You already we have ticked the CD are the policies in respect of which he can claim the exemption. F policy हमारे पास अभी remains, so इसका proceeds would be taxable, right? यहाँ पे what is the requirement of the question? What would be the capital gains computed under section 45(1)(b)? Section 45(1)(b) insert this clause B subsection is being inserted on section 45 to provide for the taxability in respect of these ULIPs. Right. So capital gain computed under section 45(1)(b) in the hands of Mr. Manoj for the assessment year. See, maturity process is going to be received in the year 2030. So assessment at 3031 has to be seen. In 3031 May only that maturity process would be taxable. Assume that for the purpose of this, no consideration was received prior to maturity date. This assumption is given since in case some consideration the policyholder has already been received, then that portion also has to be considered while doing this computation of capital gains. That also has to be part of your maturity proceeds. Whatever consideration you have received, that also already being taxable ho jayega. On that year, it become taxable. Again, you need not to consider it. What you will do? We have already computed. Up capital gains is arising only in respect of policy F. Since he has claimed the exemption in respect of C, D, and E. The policy F pay, we already computed the capital gain. It is coming to 5,50,000. So correct answer is 5,50,000. Now fourth question. Again, a very good question actually. This is यहाँ पे there is integration of two or more provisions. What is the Manoj tax liability? Some other information is also given in respect of Manoj. What are those information? Let's see. Mr. Manoj, dividend income he has earned, and he has LTCG, and he deposited 1,50,000 in NPS, right? अब यहाँ पे total income के लिए 12 lakh आपका आया है proceeds, dividend income. फिर आपका आया 5 lakh का LTCG. This is LTCG. How much it is? 5 lakh. And he has maturity proceeds. इस year assessment year 22-23 में some policies are going to be matured. What are those policies? किसके respect में exemption है? A के respect में तो he can claim the exemption. What are the B policy? B policy is not exempt, so it become taxable since it exceeds the 10% of capital sum assured. अब how we have to compute the income? Income कैसे compute होगी? How much it has paid? Maturity sum कितना pay कर दिया इसने? It's paid for 7 years, right? It's paid for 2,80,000. It's coming to 1,20,000 is the amount of income chargeable to tax under the head other sources. chargeable to tax under the head other sources, not capital gains. It's prior policies which maturity proceeds are the income arising from those policies are taxable under the head other sources, right? So it has the income of
40,000 is the premium for 7 years, 2,80,000. Premium has to be deducted from the maturity proceeds. The remaining 1,20,000 is subject to tax.
So LTCG maturity proceeds भी आया आपके पास other sources में, it is 1,20,000. ठीक है, LTCG के अगेंस्ट में कोई डिडक्शन नहीं मिलेगी. इन रिस्पेक्ट ऑफ दिस चैप्टर 6 की डिडक्शन मिल सकती है डिविडेंड के अगेंस्ट में और अदर सोर्सेज के अगेंस्ट में. सो 80C के लिए क्या डिडक्शन मिलेगी? इन रिस्पेक्ट ऑफ विच ही विल बी एलिजिबल फॉर 80C डिडक्शन in respect of all the policies if the to the extent of that annual premium does not exceed 10% of sum assured. आपने देखा A के लिए it had made the payment during the year 50,000 plus 35,000 हमने B के लिए provide किया. Then annual premium 1 lakh all the policies. तो 1 lakh for C के लिए, then D के लिए it is मतलब all the premium exceeds 1,50,000. 80C की deduction has to be restricted to 1,50,000, right? It has also deposited NPS in Tier 1. In respect of NPS schemes, an individual is eligible for additional deduction that is not restricted to section 80CCE of rupees 50,000. 80CCD 1B में you will get the deduction in respect of NPS, right? So total deduction कितनी हो जाएगी? How much? It is 2 lakh under chapter 6. अब यहाँ पे 12 lakh और 1,20,000 में से you have to reduce this 2 lakh rupees and then you have to compute it's taxable at the rate. This income is taxable at the rate 20%. It's coming to 1 lakh. Right? This is 12 lakh plus 1,20,000, 13 lakh 20,000, 13 lakh 20,000 minus 2 lakh. It is coming to 11 lakh 20,000. It is not opting for 115 BAC. So it is not opting for BAC. Then the income is normal provisions. So it will be taxable. The amount would comes to 1,48,500. Right? It is coming to 2,48,500 plus cess of ₹9940. This is HEC. And the amount total comes to 2,58,440. This is the tax liability. यहाँ पे आपने देखा you have seen 80C आया. This information you have to keep in mind. 80CCD 1B आया. 1B also comes into picture, right? In respect of this also he is eligible for the deduction. So these are the two deductions you have to consider while computing the total income. Accordingly, tax liability has to be computed. What is the fourth question? Fourth question is in respect of tax deductible. We already computed this. Correct answer is 2,58,440. Or question 5 is in respect of tax deduction.
You have to click here and I think use this one.
Going up and down. Just a minute. Yeah. What would be the total tax deductible under section 194DA during the previous year 21-22? It has received maturity receipts of two policies. One of the policy, that is policy A, is already exempt, and policy B, in respect of policy B, the proceeds are taxable, right? Since it exceeds 10% of sum assured. So you have to compute the income from in respect of that policy. In respect of section those income, section 94D mein 5% TDS is deductible. So maturity proceeds we have already computed 1,20,000 was the income, net income. Okay, that 5% the tax amount comes to 6,000. Then correct option is B. This is about the ULIP taxability and life insurance policies के लिए. What are the sections you have to keep in mind? Section 1010D, 45(1)B, 80C, right? These are the sections you have to keep in mind while answering ULIP related question. Now we are moving to the other part of our.
So this will answer Prasad's query.
Yeah.
Okay. So last year, last year, these two sections were introduced. Like 9B 45.4 is already there. This particular scheme of taxation of capital gains in case of, let's take dissolution of a firm and reconstitution of a firm. I hope you all must be knowing very well what is the difference between the two. Dissolution of the firm ceases to exist. And in case of reconstitution of a firm, it's a resignation or it's an admission of a partner with other partners continuing. And also it can be a change in profit sharing ratio. So that's reconstitution. Okay. Now, two provisions are attracted in this case. Can you please help? The screen is not moving.
Very difficult actually.
Yeah. But why is it not moving with the
working keyboard?
Chalo. Okay. Now, when we go to assets received by partners, section 9B, in case of section 9B, both the asset, when the firm is dissolved and the partner receives capital asset or stock in trade, then 9B is attracted. Okay. And in case of a firm is reconstituted and a partner receives capital assets or stock in trade, 9B is attracted. If he receives money or capital asset, 45.4 is attracted. Okay. So in case of dissolution, only 9B is attracted. In case of reconstitution, both 9B and 45.4 are attracted. Here, 9B means capital asset or stock in trade, and 45.4, what is covered is money or capital asset. Here, what we notice, if it is a capital asset on reconstitution of a firm, then both 9B and 45.4 are attracted. So, how do we go about calculation? CBDT has also come out with its own circular in this regards guidelines, and we have to take that also into account when we are calculating. Now, what happens? Now, in the year in which the capital asset or stock in trade is received by the partner on the dissolution of the firm, okay, or on reconstitution of the firm, if it's a capital asset and stock in trade, the FMB, then 9B is attracted. At the first instance, when the capital asset is given to a partner on dissolution or reconstitution, 9B is attracted. And the fair market value of the capital asset on the date of receipt by the partner is the full value of consideration, fair market value. And how do you proceed to compute the capital gains? As per the provisions of capital gains, if it's a capital asset, as per the provisions of profits and gains of business or profession in case of a stock in trade. It's deemed transfer in the hands of the firm, not in the hands of the partner. Okay? Also, if it's a case of reconstitution and you receive money and capital asset, then as far as that provision is concerned, 45.4 is attracted, and the excess of money received and fair market value of capital account over the balance in the capital account of the partner on the date of reconstitution will be deemed as income of the firm. See, whatever a partner receives, which is over and above his capital balance, that is brought to tax under 45.4. Under 9B, what is brought to tax? The excess of fair market value of the capital asset over its cost or over its cost, that is brought to tax in 9B. In 45.4, what is being brought to tax? The excess of money plus fair market value of capital asset minus the capital balance on the date of reconstitution. Okay. Now, this capital balance is to be calculated without taking into account increase in capital due to revaluation of asset or self-generated goodwill. That you should not consider. Okay. Now, how you will go about it? This we'll explain with the help of the case scenario. So, this I hope is broadly clear. In case of only dissolution, only 9B is attracted. In case of reconstitution, both 9B and 45.4 will be attracted where it involves capital asset, where capital asset is given to a partner, then both will be attracted. 9B covers capital asset and stock and trade. 45.4 covers money received and capital asset. We will see how it is being applied through this case scenario. It is that May 22 ka case scenario, but however, we removed the case of dissolution because in the case of dissolution, there's no confusion at all. It's only 9B. So because of paucity of time, we will not be covering dissolution in a case of dissolution, we'll be covering a case of reconstitution. Prem is a partner in Exxon Company Mumbai, which has 4 partners, including Prem, who share profits and losses equally. So Prem's share will be okay. Prem's share will be 1/4. On the said date, that is 1/4/2000, the capital balance of each partner is 32 lakhs. In order to settle the dues of Mr. Prem, the firm revalues its land for the first time since purchase. The valuer also valued self-generated goodwill at 70 lakhs. The firm has the following capital assets. So they've given the details of capital assets. Basically, the capital assets are land at Pune, Nagpur, Mumbai, and self-generated goodwill. Now, when it's doing the valuation for the first time, it's come. This is the original cost, which is recorded in the books of accounts, and this is the valuation. Now, as per the valuation report, this is the valuation, and we can see that all lands are long-term capital assets because they have been held for a period of more than 2 years. It's been purchased in 13, 15, and 30. So it's held for more than 2 years. It's a long-term capital asset. Okay. Now, in April 2021, Exxon Company gave land at Nagpur. This land is given. Okay. Land at Nagpur and 15 lakhs money to Mr. Prem to settle his capital balance. So Prem is given this land plus he's given 15 lakh money. Okay. Now we see how various provisions are attracted. It's a case of reconstitution because the other partners, Prem is leaving, other partners are continuing. So it's a case of reconstitution. And since capital asset is given to Prem, land at Nagpur is given to Prem, both 9B and 45(4) are attracted. 9B, as I said, covers capital asset. In this case, there's no stock in trade, so it covers capital asset. So 9B, how do you calculate? 9B is very simple. You take the fair market value. This is the land at Nagpur, which is given to Prem. Okay. You take the fair market value that is deemed to be the full value of consideration. Okay. 9B now we are calculating 45 lakhs. Okay. That is the full value of consideration. I have to deduct indexed cost of acquisition because it's a long-term capital asset. 25.4 is the cost. Now let me provide indexation. Current year is 317. What is this year? It's 2015-16. 2015-16 ka it's 254. Current year is 317. Okay. So it's 317 divided by 254. That will give you 25.4 into 317 divided by 254 will give you, 25.4 into 317 divided by 254 will give you 31.7. Okay. This is the indexed cost. So what is the difference between this? It is 13.3 lakhs. This is taxable under 9B. This is basically what on transfer of land at Nagpur, a normal capital gains computation for fair, because you've given the land to him. You've given the land to him, so I have to take the fair market value of land and I have to reduce the indexed cost of acquisition. 25.4 is given as the cost, indexation is given, so it's a simple computation, 13.3. So the answer to the first MCQ is 13.3, amount taxable under 9B. Now we have to see about application of 45(4). Okay. For 45(4), I told you it's the excess of money received. Should I, 1 second. This we know as 13.3. This is important now. I'm now going to rub off 13.3. Okay. Now. Okay. Now. What we have to do? We have to see 45(4). 45(4), what does it say? Money received. Money received is 15 lakh money received. 15 lakh is the money received. Okay. Then fair market value of capital asset, that is 45 lakhs. This is the land which is given to Prem, 45 lakhs, 60 lakhs. Minus capital balance. Capital balance, we cannot directly take it as 32 lakhs because we have to give effect to the capital gains arising on sale of land at Nagpur. How do we give effect to? That is given in the CBDT circular. First, you have to compute the book capital gains, book profit. That is without considering indexation. We have to consider the book profit. What is the book profit? 45 minus 25.4. This is the manner which is suggested by the CBDT in its examples. This comes to 19.6. Aparna, just check it, it's 19.6. Huh? Okay, this is the book profit. From this, I'll have to reduce the tax which I have to pay on 13.3 lakh capital gains. So 13.3 lakh, 13 lakh 30,000 mein, what is the rate of tax? It's 20.8%. 20% is the rate of tax on capital gains plus 8% is the cess. 20.8% on 13.3 lakh. 13 lakh 30,000 into 20.8%. That is 276,640. 276,640. This I have to reduce from the book capital gains. Book capital gains, that is 45 lakhs minus 25.4 lakhs, which comes to 19 lakh 60,000. So what do I get? 16 lakh 83,360. Okay, 1680. What did I do now? I simply reduced 25.4 lakhs from 45 lakhs. This is the asset which is given to Prem. What is the book capital gain without considering the indexation factor? 19 lakh 60,000. From that, whatever tax is payable on capital gains, that I have to do 13.3 lakhs is the capital gain computed under 9B. Tax is 20.8 on that. That will come to 276,640. When I reduce that from 19 lakh 60,000, net book profit is that 16 lakh 83,360, which I get. This is for all 4 partners. This has to be distributed to all 4 partners. So divided by 4, I'll get 428.40. Okay. So 428.40 if I divide it. Okay. Now, what is the capital balance of Prem? In fact, every partner's capital balance will now increase like this, but Prem's is more relevant because I have to reduce it. This comes to 3620,840. Prem's capital balance. Fine. Now what I do? What is my this one? What does Prem get? Prem gets 15 lakhs in cash. 45 lakhs is the capital asset. 60 lakhs he is getting. His capital balance, what I have to reduce is 3620,840. So what is my capital gains now? Let me erase all this now. So my capital gains will be this 60 lakh. 60 lakh is again 15 lakh money plus 45 lakh fair market value. It's very easy. This 36 lakh, what did we get there? 36 lakh 2840. 36 2840. Now 60 lakh minus 36 2840. It's 20.
Yeah.
Sorry, 2379,160. I hope the computation is right.
2379.
But how do I determine? This is the capital gain taxable under 45. But how do I determine whether it's a long-term capital gain or short-term capital gain? Here again, CBDT has told how you must go about determining it. Okay, you have to see what are the remaining assets. Okay, and how much the value has increased on account of revaluation. This asset you don't need to consider. This is the asset which has gone to Prem. Don't need to consider this. Remaining assets, what is it? Land at Pune. Okay. Now, land at Pune, it has, how much has the value gone up by? 50 lakhs minus 15 lakhs, it's 35 lakhs. Value has gone up by 35 lakhs. Then land at Mumbai, how much has the value gone up by? 250 minus 88. 162 lakhs, the value has gone up by. Self-generated goodwill, first time it has been valued. So it's full 70 lakhs. So these are the only assets which has been given to us. So this one we need not consider because this has been given to Prem. Other assets, what is the value? It has increased on account of this valuation process. 35 lakhs, 162 lakhs, 70 lakhs. Okay. So what is the total? 35 plus 162 plus 70, 267 lakhs. It's the total. Now we have to see the proportion to determine how much of this is long-term capital gains, how much is short-term capital gains. How do you go about determining? That also, the rules have been prescribed for this purpose, which says that, I'll just take you to that rule. See, how do you go about determining? If it's a capital gains on sale of, it will be a capital gains on sale or transfer of short-term asset if the capital asset is a short-term asset at the time of taxation. That means it's been held for less than the prescribed period of holding. In case of land, it is 2 years. Suppose the land was held for 1 year, it would have been a short-term capital asset. But in this case, long-term, land is a long-term capital asset. So that is not a short-term. Capital asset forming part of a block of asset. If it had been building, it would have been a block of asset, then on which the depreciation is provided. In this case, we don't have any such asset. Or if it's a self-generated goodwill. Yeah, we have a self-generated goodwill here. So the capital gains, which is attributable to self-generated goodwill, will be short-term capital gains. Then capital gains, other assets not covered in one above, and is a long-term capital asset. So any capital gain which is attributable to land held for a period of more than 2 years, in this case will be a long-term capital gain. What is attributable to goodwill will be a short-term capital gain by virtue of Rule 8AA, sub-rule 5. Okay, this is also given in your study material. So actually, it's a different methodology of computation. So far, whenever we compute capital gains, it will depend upon the period of holding of the existing asset. In this case, whether this capital gain is long-term or short-term, how much is long-term, how much is short-term, will depend upon the remaining assets which held by the firm. Okay, and it is distributed in proportion, not the increased value. You don't distribute in proportion of 50, 250 and 70. No, increase in value on account of the valuation. So increase in value is 35, 160 to 70. You have to distribute 23,79,160 in that proportion. Let us see the thing. 23,79,160 into 35 divided by 267 will give you 311,875. 311,875. I'm putting it in this thing. There's so much of figures you tend to get confused. Here it's 311,875. Here it's 1443,535. For this one, it is 1443,535. Okay, and then 23,79,160 into 70 divided by 267. That will give you 623,750. 623,750. This is short-term capital gain because it's attributable to goodwill. So it has to be treated as short-term as per Rule 8A. So these two are long-term. So how much do we get? 311,875 plus 1443,535. That will be 17. These two total together is 1755,410. Okay, that is long term plus 623,750. Will you do I get a total of this thing? So 1755,410 is long term and 623,750 is short term. You understood now the manner. Why is it treated as long term? How much is treated as long term and short term depends upon the remaining assets. Increase in value of the remaining assets which are held by the firm. This is the manner in which we have to calculate as per the CBDT circular. So what will be the answer in this case? Thank you. Here, so it's 1755,410 and STCG of 623,750. See, normally you might be tempted to write 23,79,160 is the capital gain we got. If you had got that answer till that point, let us say you've done the calculation correctly, you would have got this particular answer, not 2371. You would have seen that and directly picked A, na? So that would have become the wrong answer. This is the problem in MCQs. What we are telling, one thing which you have to keep, because here the methodology of allocating the capital gains is prescribed by the CBDT. They have said if it relates to land which is held for more than 2 years, it's long term. If it relates to something in the block of asset, or if it relates to goodwill or land which is held for less than 2 years, for that matter, it would have been a short term. So that depends upon the remaining assets, the increase in the value of remaining assets, which have to be taken into consideration for allocation of capital gains. So this is something you have to be extremely careful about. Okay. This we've talked about the way in which you have to compute. This is number 2. Okay. Number 3, question number 3 will be amount which is apportioned between these two land. What would be the amount apportioned to land at Pune and land at Mumbai to be reduced from the full value of consideration? Okay. Now what happens? You've done this apportionment. Okay, we've done this apportionment. This 311,875 is attributable to land at Pune. 1443 is attributable to land at Mumbai. What does it mean? Is it affecting my cost of acquisition? It's not affecting my cost of acquisition. Subsequently, when land at Pune is sold, let us say it's been sold after 2-3 years. Okay, then from the sale consideration, from this one, you have to reduce this full value of consideration, whatever may be at that particular point of time. You have to reduce 311,875. Fine. 311. Likewise, when this land at Mumbai is being sold after 2-3 years, then this amount 14,43,000, which is a portion, will have to be reduced from that at the time when it is sold. Currently, you are just doing the apportionment for the purpose of determining the taxability of the capital gains in the other year. Actually, why are they giving the benefit that you reduce it later on when the asset is sold? Because this particular capital gain, now what is actually happening, what the partner is getting, what money capital asset over and above the capital balance, whatever he is getting, is deemed as income in the hands of the firm. Whereas ideally speaking, it should have been partner's hands, but they are taxing it in the hands of the firm. So what benefit they are giving? It's been taxed in the hands of the firm, but okay, when you're going to sell that asset on a future date, I will allow you to reduce that portion which has been apportioned to that particular asset, so that when you sell the asset at the future date, that particular apportioned amount will be reduced from that asset. That is the meaning of this apportionment also. So this is the crux of 9B and 45(4). Queries? Yes. Question number 4, we have not taken up because actually, as I told you, Prasad, I have not done dissolution. Dissolution case is very simple. There were 2 more questions which were included, which was a case of total dissolution where only 9B is attracted. So I have not taken up all the questions in that. I will check it up tomorrow because I don't have that question in front of me right now. I will clarify it to you because other questions were simple and straightforward. If it's a case of dissolution, now you need not go into 45(4) at all. It is directly based on 9B itself. Okay, that is the reason why I removed that part of the case scenario and concentrated on reconstitution where both 45(4) and 9B are attracted. I hope these are very clear to you. 1 lakh deduction for LTCG, that is 112A. Here we are talking about 112. Land at Nagpur is 112 will get attracted. The rate of tax is 20%. You are asking about 1 lakh deduction. 1 lakh deduction is under 112A. 112A when it is listed equity shares on which STT is paid, in respect of which capital gains if it arises in excess of 1 lakh, it will be chargeable to tax at 10%. That is only for listed shares, units of equity oriented fund. You don't confuse that with land long-term capital gain on sale of land, which is taxable at 20% under 112.
Prashad is asking about it's November 22. So you are talking about the first case scenario, question number 4 MCQ, which we already discussed. Please confirm, Prashad.
Chalo, in the meanwhile, you want to cover that for question number
4 is regarding to tax liability of Mr. Manoj. I think if it is so, then we will, yeah, ma'am, for all these.
You want to do that now?
Should I?
Chalo, okay. Complete. Prasad, I presume you are asking for that ULIP problem, how to compute the tax liability. She's explaining once again.
Yeah, Mr. Manoj tax liability here, no? What we have done here, already completed it. Here. Yeah. See, this question number MCQ 4 is asking about to compute the tax liability of Mr. Manoj. Here he is having the dividend income of ₹12 lakh and LTCG. Here it's a long-term capital gain of 5 lakhs. See, it's again taxable under section 112. So यहाँ पे you will not give you the deduction of 1 lakh rupees. And in respect of this maturity proceeds, if you're talking about, then in respect of this maturity proceeds, na, it's 1,20,000 is there. So it is taxable as other sources, not as capital assets. These are the life insurance policy, right? Life insurance policy ke case mein, what you have to do, you have to see this that limit of 10%. That if it is exceeding 10%, then such amount would be taxable under the head other sources. So 112 we may, if it is a taxable, then 1 lakh limit is allowable, right? Here it is taxable under the head other sources. So whole 1,20,000 is taxable as per the normal rates. I think it's you are having this doubt. Or LTCG here again it's taxable under section 112. So it is taxable at the rate 20%.
It's land, LTCG
Yeah,
on
it's
sale
on
of land.
I think this is the doubt you must be.
And as far as deduction is concerned, in respect of life insurance premium, the deduction of 1,50,000 is provided, and 50,000 additional deduction under 80 CCD 1B in respect of National Pension Scheme. That is additional deduction. So 2 lakh is the total deduction which is allowable.
Yeah.
Okay.
This is the thing I think. We scroll down. Now we can move to the
Section
other
50.
Yeah, 50B.
9B and 45.4, I hope it's clear. It's a very important provision. It is a little bit difficult also because it moves away from what we normally learn. Another thing which is very important is slum sale because of the recent amendments which have taken place. So that's why we have taken up 50B. Now, when you do when there's a slum sale, that means normally what it means that you don't identify values for individual assets. That's how it has been all a while. But now the scheme has changed, and you will have to identify the values of the individual assets also, even though it's a question of slum sale. Okay. Now let's go to the basic flowchart. This is given in your study material also. Is the undertaking which is sold on slum sale held for more than 36 months before transfer? If it is held for more than 36 months, resultant gain is long-term capital gain. No indexation would be available. But imagine that this is important. This is an old provision only. This is not an amendment, but no indexation would be available. Sometimes they give you the indexation factor in the question also, but even then nothing is, it's not available. Then LTCG is taxable at 20%. Okay. Now, if it is not held for more than 36 months, then it's short-term capital gains. It will be normal rates of taxation. Computation of capital gains on slum sale. For that, you have to, how do you compute normally? You take the full value of consideration, you deduct the cost of acquisition and improvement. Okay. Now, what is the full value of consideration in this case? It's the fair market value of capital assets on the date of transfer. How do you arrive at this fair market value? It's the higher of FMB1 and FMB2. What is that? That I will tell you separately. Okay. Now, what you deduct deemed cost of acquisition and improvement. What is the cost of acquisition and improvement? They say net worth is the cost of acquisition and improvement. And how do you compute the net worth? It's the aggregate of total assets of the undertaking minus the value of liabilities appearing in the books of accounts. Okay. Aggregate of total assets of the undertaking. Here they've not written books of accounts. So you will have different valuation of rules. As far as liabilities is concerned, as appearing in the books of accounts. That is very clear. Now, for net worth, in case of depreciable assets like machinery, building, and all, WDV as per Income Tax Act, you have to take. Self-generated goodwill, they've particularly given as nil. Capital assets where the whole expenditure has been allowed under 35AD. What is 35AD? 35AD is the capital investment linked tax deduction available in respect of specified businesses. So what are those specified businesses? It can be cold chain facility. It can be hospitals with more than 100 beds for patients. It can be hotels of 2-star or above category, production of fertilizer, warehousing facility for agricultural produce, warehousing facility for sugar. There are other specified businesses. You see 35AD, you will understand. In respect of those business, 100% of the capital expenditure is allowed as deduction. 100% it's allowed, and they will not be entitled for any depreciation because the entire capital expenditure has been allowed. However, expenditure on land, goodwill, and financial instrument is not allowable. These three are not allowable. All other capital expenditures fully allowable. If this is a business of the undertaking which is sold on slum sale, is a specified business wherein 35AD reduction is allowed. In respect of that asset, you have to take the cost as nil. Okay. And in case of any other assets, apart from these three, any other assets means you have to take the book value. So this is as far as cost of acquisition is concerned. Okay. And then revaluation effect has to be ignored. Okay. No effect has to be given for revaluation. This is also good. Now, here now we come to full value of consideration. Okay. This is where rules have been specified now. Rule 11 UAE has been specified. Full value of consideration, how to determine it's a higher of FMB1 and FMB2. Okay. And uske liye some values have been prescribed by the rules. You have to take specific values for specific certain assets. Okay. Whereas cost of acquisition, what we saw net worth, there again some values have been given, like WDV for depreciable assets. For goodwill, it is nil. 35 AD assets, it is nil. And other assets, it's book value. They've given there again, values have been prescribed. In FMB, in Rule 11 UAE also prescribed some values, because of which students get confused. What value do I take for what? So that's why this chart has been prepared, so that you understand what value do you take for FMB purposes, what value you take for cost of acquisition purposes. This is last column. Column 4 is cost of acquisition. Column 2 is for FMB of capital assets transferred. Okay, FMB, this column 3, now it's FMB of consideration received, because the higher of these two will be the full value of consideration. But here you have to note FMB of consideration received will be the assets which I'm receiving. That is not the assets which are existing in the organization. So you will not get confused with that. Basically, you will get confused between 2 and 4. FMB of capital assets which are transferred by way of slum sale, because in respect of these capital assets only, you have to see the cost also. I hope I am clear to you. So now we take asset by asset. Now we take first immovable property, land. What do we take as full value of consideration of land? As per 11 UAE, you take the stamp duty value. Okay. But for the purpose of cost, net worth ke liye, what do I take? I take the book value. It is not falling within that specified WDV of specified assets. Goodwill ke liye nil, 35 AD assets ke liye nil. Remaining is book value. So this is remaining book value. Okay. Now, immovable property mein what else is there? Land is there. Land is stamp duty value for the purpose of full value of consideration. For the purpose of cost, it is book value. Then building. Buildings, there can be two types. One is on which depreciation is claimed. One is on which section 35 AD deduction is claimed for specified businesses. As far as full value of consideration is considered, for both you have to take stamp duty value. Fine. It doesn't affect this. Now, what about cost? If it's a building on which depreciation is claimed, you take WDV as per Income Tax Act. Okay, normally WDV as per Income Tax Act is given in the question. Suppose the question doesn't specify the WDV of Income Tax Act, then you have to take WDV as per books of accounts, assuming that Income Tax Act is the same as that. If no information is mentioned, if both information are mentioned, you have to take the WDV as per the Income Tax Act. Okay. Now, building on which 35 AD deduction is claimed, for that full value of consideration is stamp duty value, but my cost is nil, because that explanation 1 and 2 specifically provide in case of 35 AD, my cost of acquisition will be nil. So for when I'm computing the cost, I take the cost as nil, but when I'm computing FMB, I have to take the stamp duty value. Okay. Now, other assets on which depreciation is claimed, immovable property I've claimed, other assets on which depreciation is claimed, for the purpose of full value of consideration, I have to take book value. For the purpose of cost, I have to take depreciation. Any asset on which depreciation is claimed, I have to take depreciation, WDV as per Income Tax Act. Now, what about self-generated goodwill? For cost purposes, it's been specifically provided as nil. What about for 11 UAE? There's no specific provision in 11 UAE. But what happens as per AS 26 and Ind AS 38, self-generated goodwill should not be recognized in the books of account. Okay. So, when nothing is prescribed, it will fall under the residual category of book value. Since there is no, it is not recognized in the books of account, this will also be nil. Value for the purpose of full value of consideration will also be nil. You understand the logic now? Because one is, nothing has been prescribed specifically for 11 UAE. The residual category is book value. Okay. But nothing is recorded in the books of accounts in case of self-generated goodwill as per AS 26 and Ind AS 38. It should not be recognized in the books of account. So there will be no value in the books of accounts, due to which it will be nil for the purpose of full value of consideration. Now, other assets. Leaving all this apart, other assets, shares and securities. Here you have to take book value for the purpose of cost. It will come as residuary value because only 3 things have been specified. Other things it will be book value. But for the purpose of full value of consideration, you have to take the FMV as per Rule 11 UA1. 11 UA1, if you go, you will see the transaction value you will have to take in respect of listed shares, or in respect of unlisted shares, there's a formula given. As per that formula given, you have to calculate, and that will be the FMV. Okay. As regards jewelry and artistic work, for full value of consideration, you have to take open market price based on registered value or report as full value of consideration. Cost, what do you take? Book value. Okay. Then other assets not covered above. None of, if you have exhausted all these assets, remaining assets may both are the same. Cost and full value of consideration is the same. For liabilities, both are value as per books of accounts. There are specific exclusions when you're computing Rule 11 UAE, as given in Rule 11 UAE, that you go through it, but basically equity share capital, proposed dividend, then provision for taxation, unascertained liabilities, those are given, that list is given, you go through that specific exclusions. So now this way you have to do, you have to add the total value of assets, reduce the value of liabilities, you will get FMV1. Here you will get cost of acquisition, cost of improvement for the purpose of this thing when you do it in this third column. Second column is what? Second column is the FMV of consideration received. The higher of these two will be the full value of consideration. So consideration received, one of course is the monetary consideration which you receive. By and large, it's monetary consideration. Suppose they give me land and building by way of consideration, then I have to consider SDV of the land and building on the date of valuation. Everything is on the date of valuation, the date of sum sale. Other assets on which depreciation is claimed, you take the open market value. Suppose I receive some other assets on which depreciation is claimed. Suppose they give me building or something like that. It will be the open market price based on registered value or report. Not building. Building we've taken up above. If it's some other assets like machinery or something else, then it is open market price. For building, you have to take stamp duty value. Then other assets, if it's shares and securities, you take FMV again as per 11 UA1. Jewelry, artistic work, FMV as per 11 UA1. And other assets, open market price based on registered value or report. These information will be given to you in the question. Okay. Then you arrive at FMV2. Higher of these two will be the full value of consideration. Okay. As I told you earlier, indexation benefit is not available for slum sale. We will be doing an MCQ. This will help you to explain. Okay. ABC Limited has 2 units. Unit A, Unit B, both of which commenced operations on 1/4/2015. This full screen is not visible. Okay, thank you. ABC Limited has 2 units, Unit A and Unit B, both of which commenced operations on 1/4/2015. Okay. Now, it sold Unit B on slum sale on 1/7/2021 for 1.5 crore. Okay. So FMV2 is straight away given. It's monetary consideration only. It's 1.5 crore. We need not do any further calculation for FMV2. Unit B is engaged in the specified business of operating warehouse facility for storage of sugar and has claimed deduction under section 35AD in an earlier previous year in respect of entire cost of eligible asset purchased. So the 35AD will come into picture now. How it will come into picture, we'll see. What are the eligible assets? What are the value of assets they've given? Land they've given, building they've given, debtors they've given. Then liabilities may unsecured loan, current liabilities. Revaluation reserve, which we'll have to exclude it. Okay. Now let me do FMV2. We've already got that FMV1 and cost of acquisition and cost of indexation. That is what I have to do the working here. Okay. Now, land is an asset in respect of which 35AD deduction will not be available. This I've already told you. Entire cost of capital asset other than land, goodwill and financial instrument. So land ke liye 35AD benefit will not be available. Now we have to see what is this one. For FMB1, what is the value of land which you have to take? Tell me, Prasad, everybody, what is the what is the value of land which I have to take? All the others can also answer. What is the value of land which I have to take for FMB1? Just now we discussed. No answers. Chalo. It is the stamp duty value, which you'll have to take for FMB1, fair market value purposes, full value of consideration. I have to take the stamp duty value, 95 lakhs. Okay. What is the cost of acquisition? It's given 80 lakhs, but it's given as revalued figure. It's a book value, but it's a revalued figure. And I have to remove the effect of revaluation. Okay. Revaluation reserve for land is given as 6 lakhs. Okay. I have to remove the effect of revaluation from here. So 80 minus 6, that will give me 74 lakhs, which is the book value. So cost of acquisition of land is 74 lakhs. If this way you do it, it will be easier for you to understand. This is stamp duty value for FMB1. And for cost, it's the book value, but I have to remove the revaluation effect. So it's 80 minus 6, 74 lakh. Okay. Now building. Building is an eligible asset which qualifies for 3580. And he has claimed deduction. The deduction has been claimed under 3580. So what will be the cost of acquisition of that? It will be nil, because it's an asset in respect of which 3580 deduction has been claimed. So for cost of acquisition, it will be nil. But what about FMB1? For full value of consideration, I have to take the stamp duty value. Okay. For that, it will be 60 lakhs. That is prescribed by Rule 11 UAE. We've seen here now. I'll go back here for a minute. See, building on which 3580 deduction is claimed. For the purpose of full value of consideration, I take stamp duty value. For the purpose of cost of acquisition, it will be nil. Okay. So this is nil. Now in respect of debtors, it will be the same book value here for full value of consideration, book value here for cost of acquisition. Okay. Now total these three, it will be 7, 9 plus 6, 15 plus 1, 167. Here it will be 74 plus 12, it will be 86. It's not over. Now what about liabilities? Here it's a clear-cut case, both are liabilities, and in both cases you have to take the book value. Liability is totally 20 lakhs. This revaluation we've adjusted against land figure. Okay. So 20 lakhs are reduced from this, 20 lakhs are reduced from this. This is 147 lakhs. Here it is 66 lakhs. Okay. Now 147 lakhs is my FMB1. I have to compare it with FMB2. FMB2 is what? FMB2 is 1.45 crores. So which is higher? This is higher. This is 1.47 crores. So this will be my full value of consideration, 147, and cost of acquisition is 66, which we've computed. So this will be 81. So the answer is D. I hope it is very clear to you. In this manner, if you proceed, FMB, for each asset, what is the FMB, what is the cost, you will arrive at both the values. Of course, for FMB1, you will get the FMB1 figure, you compare with the FMB2 figure. In this case, it's a straightforward case. It's only monetary consideration. It's 1.45. Suppose he had got some land building also, you have to take the stamp duty value, and for other assets, the respective values which is given there. Then you do make a comparison, whichever is higher. You take it as the full value of consideration minus the cost of acquisition, which is 66 lakhs in this case. So I hope this is very clear to you all.
Prashad answered. Your answer was correct, Prashad. And Yogesh also answered. It's 95 lakhs. Yeah. Land value we asked, ma'am.
Okay.
The land value, you understand?
Yeah, okay. Good.
Yeah.
Prasad and Yogesh, very good. I hope actually what happened now, we had already in 2-9, the next intermediate session will start sometime. You want to we have another 5 minutes maximum. Should we start?
Because today we are able to finish the section 1 related things, and section 2 relates to charitable trust. So here we are going to cover the major amendments in the section 2 basically. Just a minute, if show you what type of question are being asked. Is the weightage is
the remaining capital charitable trust will continue tomorrow. Whatever we can in the next 5 minutes we will.
So section 1 we have covered, amendments, major amendments we have covered. There are other amendments also. Kindly go through those. Start update also, please go through for the exams, right? These are the major things we try to cover to explain you with the help of the examples and all. Now in section 2, the weightage is 5 to 10%. Already told you ki, what type of questions being asked. One application oriented question can be asked, which is comprising of 2 to 3 independent scenarios, right? And it would carry 8 marks. So independent case scenarios means it comes to 4 marks or 3 marks, like that will be there in this section for charitable trust or political parties or electoral trust or this. And if not from the application oriented, one full-fledged question on section 115 TD, accredited income, taxability of accredited income would be asked for 8 marks and be asked there. And the case scenario, the independent case scenario can be attested from the provisions of section 11, 1023C, corpus donations, anonymous donations. To testing these provisions, the independent case scenarios can be asked, right? In this section, there are certain amendments which are really very important, and this is the one chapter only. You have to read the one chapter, but again, the provisions are quite different from the provisions of other entities.
It's a special scheme.
Special scheme actually for doing the taxability of trust and all. So you know that section 1023 says there. Specific code of taxability provisions are there in section 11, 12, 12A, 13 is there. So 1023 says, you know, section 10 is related to the exemptions, right? Section 10 contains the provisions which provide the exemptions to various persons in respect to certain incomes. While section 11, 12, 12A and 11 to 12 sections provides you exemptions dependent on certain conditions, that 15% unconditional, remaining 85% is allowable if you apply this in particular forms in that manner. If the trust have get the approval under section 1023C and it was already registered under section 12AB, right, or 12AB, then that 12AB and 12A registration become inoperative. That means those provisions will not be applicable on them if we give in the exemption, if it is being approved under section 1023C. These are totally distinct provisions. There are certain provisions which are mutatis mutandis applicable, which are clearly stated in those sections. You have to go through the whole things carefully, right? So we are here covering you some of the amendments which are there in this section. First is relating to section 1023C. Let me explain you. Section 1023C contains the exemptions to various kinds of entities like Prime Minister National Relief Fund, Clean Ganga Fund. It is starting with those entities, Swachh Bharat Kosh, National Foundation for Communal Harmony. These the income of these entities are straightforward exempt. But the other sections are there which are exemption is provided depending on the conditions. Those are very important for you. You should understand what are the conditions against which the exemption is provided to those entities. For you remember with the help of these sections, like section 1023C 3AB, it's related to the educational trust which are engaged in the providing the education and all. If they are wholly, these entities are wholly or substantially financed by the government, right? What is this meaning of wholly and substantially financed by the financed? It's not working. What is this wholly and substantially financed? When the entity is considered as wholly or substantially financed, these trusts are considered as this: if the government grants exceeds 50% of the total receipts. Read these words. See, you might get confused. It's total receipts, means whatever be the income, whatever be the receipts of the trust, that amount has to be compared with the government grants. If it exceeds 50%, if it exceeds 50% of the total receipts, then it will be considered wholly and substantially financed by the government. In such case, the educational field mein hai, if the trust is in education field or in the medical field, then in both these cases, if it is wholly and substantially financed by the government, these entities would be exempt without getting the approval procedure, without going into the approval with the authorities. Next is in 3AD and 3AE, relating to again to the education trust or medical trust. If their aggregate annual receipts do not exceed 5 crores. This is the amendment. Basically, this is already exists. These provisions are already there. This is the amendment. If their annual receipts, earlier it was 1 crore. Now the limit is enhanced to 5 crores, and some other condition is also there. And in individually, if the trust is providing the educational facility for a charitable and as a charitable purpose, then we have to see the annual receipts. If the annual receipt do not exceed 5 crore, then it will be eligible for exemption under section 1023C without getting for the approval. In case of medical also, it's 5 crore limit is there. But again, here one explanation they have inserted. They says if the trust is engaged in both the fields, like education maybe it's there and medical also they are there, then we have to see in the aggregate of both the organizations, like both the fields, education as well as medical. If their aggregate exceeds 5 crore, then also it will not be eligible for exemption. This is very important, right? Individually, it's okay. If it is one thing, then it is 5. It is providing both the things. Education maybe it's there, and in medical also it's there. Then you have to see it in the aggregate. This is the amendment basically.
Okay. The remaining part of charitable trust we will continue tomorrow. Actually, the next intermediate sessions have to start, and so that is why we'll have to wind up today. The remaining charitable trust we will continue tomorrow. And some of the queries which we are not able to take up today, which due to paucity of time, we'll be taking it up tomorrow. Thank you.